Okay. So in our last lecture, we completed till interest income. If you remember, this part we completed interest income, right now. So all the types of interest incomes which are taxable under the head IFOS that we have completed, and we also saw that what type of interests are exempt under the Income Tax Act. Okay, no? So this part we finished in the last lecture. Now continuing from rental income. See, today we are going to finish with this chapter. Okay, all the questions and all the theory and everything we are going to finish today. And today the part which we are going to do will be very important part of IFOS. So be very attentive in today's lecture, because if you will miss something, because in today's lecture I am going to connect the gift provisions with the capital gain chapter also. Okay, so that you are supposed to be very careful about. Okay, now rental income. See, the rental income which is given here and which is given here, these two rents are taxable under the head IFOS because of specific charge. There is a specific charge, clause 2 and clause 3. This two rental incomes are taxable under the head IFOS not because there is a specific charge, because there is a general charge. So these two incomes are covered here, these two rental incomes are covered here because of general charge. Okay, so which incomes we are just now starting with rental incomes. So if you are getting rent from any plant, machinery or furniture, meaning you have let out plant, machinery, furniture, then whatever rent you are getting from that plant, machinery or furniture will be taxable under the head IFOS only if it is not taxable under the head PGBP. So first you have to try that the rent of the plant, machinery, furniture gets taxed under the head PGBP. If it is not getting taxed under the head PGBP, then there is a specific charge which says that such rent will be taxable only under the head IFOS and under no other head. Okay, so for example, I have a Sony camera which I have given on rent to one of my photographer friends. Do you remember that example which I gave in PGBP chapter? Yes. So that Sony camera, am I in the business of giving the cameras on rent? No. So that is my plant machinery, yes or no? Anything which is not a building, which is not a furniture, is a plant and machinery. So that camera is a plant and machinery which I am letting out. And the rent which I am getting by letting out that camera, that cannot be treated as my PGBP income. Why? Because I am not in the business of giving the cameras on rent. So whatever rent which I have got cannot be classified under the head PGBP. I will have to tax it under the head IFOS. But what if I am in the business only of letting out the cameras, lenses? I have a shop where I keep many cameras and all. Okay, so then the rental income by letting out those cameras will be my PGBP income. Okay, now this was your first income. Any plant, any machinery, any furniture, okay, which you let out, and the rental income which you get, first you have to make sure that it is getting taxable under the head PGBP. If yes, then okay, no problem. But if it is not getting taxable under the head PGBP, IFOS will be the head where that will be taxable. Now composite rent, if you remember that this particular concept we did in income from house property chapter. Okay, so if you are letting out your building along with plant, machinery or furniture, now the plant, machinery, furniture is not let out separately. Now that is let out along with building. So building is let out along with plant, machinery, furniture. Plant, machinery, furniture let out along with building. And these two lettings are happening together. Single letting is happening. Okay. But both the lettings cannot be separated. They are inseparable lettings. I gave you the example of classroom. I gave you the example of factory building. Do you remember that? Okay. So if both the lettings are not separable, then whatever rent which you are receiving, whatever combined rent of these two assets which you are getting together as a single rent, that cannot be separated. Don't separate that rent. Show that entire rent under the head PGBP if possible, if you are in the business of letting out building along with plant, machinery or furniture. But if you don't have such business, then then the combined rent will be taxable only under the head IFOS. That is a specific charge given in clause number 3. Okay, sir? Will you remember? Did I explain this composite rent part in house property chapter? Sure, no? Okay. Now, see this rent and this rent. Two rents are taxable under the head IFOS only if not taxed under the head PGBP. Now, if you have an open plot of land, vacant land which you are letting out, this also I have told you under the head house property. The asset which you are letting out is not a building. It is not a land appertaining to building. It is an open plot of land. Vacant plot of land. When you let out that open or vacant plot of land, whatever rent you will get, that rent cannot be your income from house property. And you are not in the business of letting out such land, you know. Hence, that rent will also be taxable under the head IFOS. But not because of any specific charge, because of general charge. Because this rent is your income, number 1. Number 2, it is not exempt under any of the provisions of Income Tax Act. Number 3, it cannot be taxed under any of the earlier 4 heads of income. So because of general charge, it will be coming under the head IFOS. Now you have a building which you have taken on rent. You are not the owner of that building. You have taken the building on rent. So you are a tenant in that building. When you further let out that building to someone else, that means you are subletting that building. So whatever rent which you are going to get by subletting that building, of which you are not the owner, cannot be taxed by you under the head house property. That has to be your income from other sources. Because of general charge, that will be taxable here under the head IFOS. Getting my point, everyone? So this was your rental income. Will you remember all these points? Sure? Okay. Now coming to the next part. This is very important part. Okay. Keyman insurance policy. See, whenever we talk about Keyman insurance policy, no? So they are saying that as per section 56, subsection 2, clause 4, this clause says that any sum received or receivable under the Keyman insurance policy, that sum can be including bonus, can be with bonus also, if any. Bonus may or may not be given, but if bonus is there, including bonus, that sum, okay, no? That amount can be taxed under the head income from salary. That amount can be taxed under the head PGBP. And that amount can also be taxed under the head income from other sources. If it is taxed under the head salary, it will be profit in lieu of salary under section 17(3). If it is taxed under the head PGBP, then there is a specific charge under section 28. And if it is taxed under the head IFOS, because of specific charge under section 56 to 4. Now one amount is taxable. The same amount is taxable under the head salary also, under the head PGBP also, under the head IFOS. This is the only payment. This is the only income which can be taxed in any of these 3 heads. Otherwise, at the most 2 heads, either this head or this head. No, this is the only income which can be taxable in any of these 3 heads. You don't have to tax it under all the 3 heads at the same time. No, decide that under which head it will be taxable. If it is taxable under the head salary, then forget about PGBP and IFOS. If it is taxable under the head PGBP, then forget about salary and IFOS. But if it cannot be taxed under the head salary, it cannot be taxed under the head PGBP, then you have to bring it under the head IFOS only. That is the, specific charge. Now, what do you mean by keyman insurance policy? Keyman means important person. Keyman means important person. So, if I am doing a business, I am a big company, for example, okay. So, in the business of a company, can there be some important persons? Who will be the important person? It can be any person. It can be the employee of the company also. It can be some outsider also. For example, some agent, etc. of the company. 50% of the sales of the company is done through agent. One agent brings 50% of the customers. So just imagine how important that agent is for the business of the company. But that agent is not the employee of the company. Though he is not the employee, he is an outsider, he is an agent. But still, he is very important for the business of the company. Can there be managing director in the company? Yes. Can there be whole-time director in the company? Yes. Can there be CEO of the company, CFO of the company? These are the employees of the company. Even they are very important for the business of the company. Just imagine if these important persons are there. If they are there, only because of that the company is earning huge profits, able to do business, okay. If God forbid something happens to them, if God forbid something happens to them, will there be a loss to the business? Absolutely yes. How much loss? The loss can be any amount. That cannot be quantified also. But their life may not be important for them, but their life is very important for the business of the company. So what the company does, company takes the life insurance of such keyman. Their life insurance they are not taking. That is different. That thing we'll discuss later. But the life of my keyman, I am insuring his life. Why? Because God forbid if something happens to him, at least I'll be able to recover some loss from the insurance company in the form of what? Insurance claim. Whatever claim the company will give me, insurance company will give me, to that extent my loss can be recovered. Loss happening in the business because of their death, etc. Yes or no? So am I taking that policy for the betterment or for the benefit of my business only? Hello? So whatever premium on that policy I'll pay, no? That is an expense related to my business. Keyman insurance policy is a life insurance policy taken on the life of some other person. That person himself is not taking his policy. His life is insured. His life insurance is taken by someone else. So I am that someone else. Company is someone else who is taking the life insurance policy for that keyman. For example, I have taken a policy of 5 crores. How much? 5 crores. That if something happens to the keyman, the company will get 5 crores. Or when the policy will mature, the company will get 5 crores. So is it taken for the benefit of the company's business? So whatever premium the company will pay on this policy will be a business expense in the hands of the company. Company will be able to take the deduction of that keyman insurance policy premium amount under the head PGBP. But remember, if that premium is paid for a keyman who is an employee of the company, don't consider that amount as a perquisite in the hands of that keyman. The company is not trying to give some personal benefit to the keyman, to the employee, by paying premium on his life insurance policy. By paying the premium on his life insurance policy, company is not trying to give some personal benefit to that keyman who happens to be the employee of the company. Yes or no? Hence, that is not a personal benefit for the keyman. Don't consider this amount as a perquisite in the hands of keyman. Will you remember? If it is a normal life insurance policy which I have taken for my employee, for that whatever premium I will pay, that premium will be perquisite in the hands of employee. That we have already seen under the head salary. But is it a normal insurance policy which I am taking for my employee? No. That policy is for the benefit of my business. Whenever the amount will not come to the keyman. The amount is going to come to me. Yes or no? How can that premium be treated as perquisite in his hands if my intention was not to give him personal benefit? So the premium I will claim as a deduction under the head PGBP as my business expense, but don't consider this premium paid on his life insurance policy as his perquisite taxable under the head salary. Ignore that. Getting my point? Now, what will happen? See, if within 5 years, for example, I have taken this policy for 5 years only. Okay, now, what was the term of the policy? 5 years. So, if within 5 years my keyman dies, who is going to get the benefit of the policy? I am only going to get the benefit of the policy, no? How much was the policy amount? 5 crores. Including bonus, I got 5 crore 5 lakhs. 5 lakh bonus also I got. That entire 5 crore 5 lakhs which I am getting as sum from the keyman insurance policy on the death of my keyman, for me it is my PGBP income, because in the course of my business I have taken this policy. Hello? In the course of my business I have taken this policy for my keyman, and that unfortunate event happened, keyman died, so I am getting that money. To the extent of this 5 crore 5 lakh, I am recovering my business loss, which is happening because of the death of that keyman. Getting my point? What if within 5 years that keyman doesn't die and the policy gets matured? Then also I am going to get the money of that policy. In the course of my business or profession, whatever keyman insurance policy I have taken, that is getting matured. So to that extent I am getting a recovery in my business. So whenever the person taking the policy, he is receiving what? The amount under the keyman insurance policy. For that person, that amount will be treated as PGBP income. Then forget about salary, forget about IFOS. Will you remember? Everyone. Now what if I endorse the policy on the name of my keyman? I tell keyman that, see, I have taken a 5 crore rupees of policy for you. I am putting few conditions that you stay with the company for 5 years, you achieve this much target, okay. Few, conditions I'll put. And that conditions can be any conditions, okay, no? But based on the satisfaction of the condition, I promise the keyman that if you follow my instructions, if you, fulfill these conditions, I will endorse the policy on your name. Meaning, premium I'll pay. Policy I have taken for you, okay, premium also I will pay. But since I will endorse the policy on your name, what will happen? If you surrender the policy or the policy gets matured, you are going to get the money of the policy and the company will not get the money, since the policy is endorsed on your name. Yes or no? Or, God forbid, if you die, your legal heirs, your nominees are going to get money, not me. So promise me that you are going to stay with the company for 5 years. Promise me you are going to achieve this much target. Promise me this, promise me that. If he has promised me all these things, okay, I am ready to endorse the policy on his name and I have endorsed that policy. The moment I have endorsed the policy, now the policy belongs to him. Now, if 5 years, for the period for which the policy was taken, term of the policy was 5 years. If within 5 years, nothing happens to him, he can surrender the policy and get the policy amount. Or he can wait for 5 years, let the policy mature, he'll get the maturity amount. Who is getting the benefit? The person taking the policy is getting the benefit, then it is PGBP. Hello? On the death of the keyman, money is coming to me, PGBP for me. If the keyman doesn't die, I surrender the policy or the policy is matured, I'll get the benefit, PGBP for me. But now the policy is endorsed. Now who is going to get the benefit of that policy? Who is going to get the amount of that policy? That keyman on whose name the policy is taken. That keyman himself is going to get the benefit. What if he surrenders the policy? What if the policy gets matured? Then for him, the amount will be profit in lieu of salary taxable under the head salary if he is my employee. What if he is not my employee? Then will that amount be taxable for him under the head salary? No. Then for him it will be income from other sources. Getting my point, everyone? What if he dies? What if the policy was endorsed on his name, okay, and he dies? So his nominees are going to get the money. For the nominees, it is always IFOS. So if the person taking the policy getting the money, then PGBP. If the keyman gets the money and keyman happens to be the employee, then income from salary, profit in lieu of salary. Yes or no? Instead of giving him this much amount of salary, this much amount given to him in the form of keyman insurance policy. So I am giving him salary only in lieu of, I am giving him salary only, but not not giving the term salary. I'm making him have that profit in lieu of salary. So don't take salary from me. Wait, I'll take a keyman insurance policy on you, on your name. I'll pay the premium, etc. You'll get this much amount from the insurance company. This amount which you are getting, I was supposed to give you as what? Salary only. but I did not give you in the form of salary. This profit happened to you in lieu of salary. If you are employee, for you it is profit in lieu of salary. But if you are not the employee, if the keyman is not the employee, he is some outsider, some agent, etc. But still he is my keyman. Policy was endorsed on his name. He surrendered the policy. Policy got matured to him. He will get the money. But for him, it will now not be his income from salary because he is not my employee. For him, it will be income from other sources. Now the amount is not getting taxed under the head PGBP, not getting taxed under the head salary. It will be taxed under the head income from other sources. What if that keyman may or may not be my employee? I endorsed the policy on his name. He dies. And on his death, his family members are getting the money. For the family members also, it is income from other sources. Will you remember this much amount? Sure. 56 subsection 2 clause 4. Done. Done. So I have explained this part, entire part. This entire part I have explained. Today at home, you are going to read this entire stuff. Not a single thing is remaining. Okay? What is keyman insurance policy? Who takes it? What are the features? Everything is explained. What about the keyman insurance policy premium? What will be the tax treatment for the premium? Yes or no? When the amount will be taxable under the head PGBP? When it will be taxable under the head salary? When it will be taxable under the head IFOS? Everything which is written here now, I have explained every damn single thing. Sure? Clause number 4 over. Now pay attention. Since we have had a discussion about the insurance policy, so let us have the discussion of the other insurance policies here only. So that we don't have to, roam around here and there in different chapters looking out for insurance policy details. Yes or no? So we'll talk about life insurance policies, normal life insurance policies also. We'll talk medical insurance policies also. We'll talk about those policies which are taken in the course of doing your business or profession also. We'll talk about the insurance policies taken for your capital asset also. We'll talk about all the policies over here. What will happen with the premium? What will happen when you are going to get the claim, etc. Yes or no? Every damn single thing we'll discuss here. And whatever discussion I'm making, no, that is not income from other sources discussion. Income from other sources discussion is this much only. Okay. But that discussion extra I'm doing here. Because every insurance policy, its premium discussion, its claim discussion, we are doing at the same place. So that you don't have to, look at different chapters. All the discussion completed here. Okay. Pay attention now. Let's first talk about normal life insurance policies. Very important discussion. Very important discussion. Normal life insurance policies. So, if I talk about life insurance policy. Now on this life insurance policy, premium, which is what? Expense. Premium will be paid or not? Now you have to see that who is paying the premium. Premium is paid by whom? Assessee himself is paying the premium. So my life insurance policy of my relatives, the premium of that policy I am only paying. Is it my expense? Yes. For this premium, will I get any deduction? The answer is yes. I am going to get deduction under ATC, subject to certain conditions. So when I'll discuss ATC, that time this premium will come there. Getting my point? So paid by the assessee himself, then deduction under section ATC will be available, subject to certain conditions, that whose premium will be allowed, how much premium will be allowed, how it is to be paid. Okay, all those discussion we are going to do in section ATC. But right now just remember that whatever premium I am paying on the normal life insurance policy, now Keyman insurance policy does not exist. Entire discussion is done. Keyman insurance. Now your life insurance policy, you are taking that policy, premium also you are paying. Okay, normal life insurance policy. Whatever premium you will pay, for that premium you are going to get deduction under ATC, subject to certain conditions. Now your life insurance policy is there. The life insurance policy of your relatives can also be there, family members can also be there, but the premium is paid by your employer. Possible or not possible? First effect, taxable as your perquisite. And second effect, later on you are going to get the deduction for that premium also under section ATC, subject to certain conditions. So if the premium is paid by employer of the assessee, then give two effects. Number one, taxable under the head income from salary as perquisite, and second effect, take the deduction under section 80C, and that will be allowed subject to certain conditions. Subject to certain conditions you are going to get the deduction. How much deduction, for whose policy, the premium should be paid, this, that, everything we are going to discuss there, don't worry. But will you remember this much only? Now, when the life insurance policy is taken, can you get benefit out of that policy? For what reason the policy will be taken? Why you will pay the premium on any life insurance policy? Because you want to have some benefit out of that policy, no? What type of benefit you will get? One benefit is confirm, death benefit. If something happens to the person who is insured, the family members, the nominees are always going to get what? Death benefit. What if nothing happens and the policy term gets over? Then death benefit will not come. Definitely no. If something happens during the policy term, then death benefit confirm. Given to insured person, no, he has died. Not to him. But on his death, his family members, his nominees are going to get what? Death benefit. But if that insured person does not die, he survives the policy term. For example, the policy was taken for 10 years. For the entire 10 years, he lives. Nothing happens and the policy matures. At that time, he is alive. What will happen on maturity? Three things are possible. He is going to get nothing. Then the policy was a simple term plan. He'll start getting annuity. He'll start getting pension. Then the policy was a pension policy, annuity policy. And if he start If he gets a lump sum amount, then that was an endowment policy. So three types of insurance policies are there: simple term plans, annuity plans, and endowment plans, endowment policies. In some simple term plans, what will happen? In all the three policies, death benefit is confirmed. But if the policy matures until that time, the insured person is alive, then what type of benefit will be given by what type of policy? Term insurance plan is there, then no benefit. Policy matured, done. So this is the simplest and the most basic insurance policy, simple term plan. Only the risk of your death is covered during that period. If something happens, family members are going to get death benefit. If nothing happens, all the premium paid, gone. Now if you want to take the policy for another period, renew the policy for another period, another term. You are not going to get any benefit on maturity. So there will not be a lump sum amount, there will not be any regular payments out of the policy will expire. Now, what if the policy was annuity policy? During the policy term, if the death happens, the family members are going to get death benefit for sure. But if the insured person survives, then policy will mature. And on maturity, now that insured person himself will start getting a fixed amount on a regular basis in the form of annuity, in the form of pension. Return on your investment taxable as income from other sources. General charge 56(1). Getting my point? But what if policy matures and you get a lump sum payment, including bonus, etc., known as maturity proceeds? What will you do? Fully exempt under section 1010D, subject to certain condition. Just like the maturity proceed, just like the death benefit is also fully exempt, this maturity proceeds will also be fully exempt under section 1010D. But to get the exemption, there is some condition which you have to follow. So now can I say from the life insurance policy, the amount is received including bonus if any, as what? Death benefit, on the death of insured person by his nominees, possible or not, then this will be fully exempt under section 1010D, D for death. Will you remember this? Now, amount is received by the insured person himself on maturity of the policy. Now that amount can be annuity or that amount can be lump sum also. If annuity is there, then it will be taxable under the head IFOS. And if lump sum is there, that lump sum can also be exempt under section 1010D, but subject to certain conditions. Will you remember? Now what is the condition to get this exemption? That is very important. Okay. So first of all, did you understand about the premium? Now, did you understand about the amount received, including bonus, if any? That amount is received on the death of the insured person by his nominees, by his legal heirs. Then that amount for them is a death benefit fully exempt. 1010D, D for death. Okay. Now, what if the insured person does not die and the amount of the life insurance policy is received by him only on the maturity of the policy? Then you have to see that how that amount is received by him. Is it received in the form of annuity? Is it received in the form of pension? Then it will be taxable as income from other sources, general charge. Okay. So in annuity from life insurance policy, pension from life insurance policy is taxable income under the head IFOS 56(1), general charge, yes or no? But if the policy gets matured, in his hands and he is getting a lump sum payment on the maturity of the policy, even that lump sum payment, that full amount will be treated as his exempt income only under section 1010D. The reason being very simple. Whatever amount he would have invested in the policy as premium, no, for these many years, that amount is only coming back to him. See, usually simple term plans will have very less premium. But the annuity plans and the endowment policies, annuity policies, they will have a big amount of premium. Because under those policies, the insurance company has promised you a certain fixed amount on a regular basis for your lifetime. So definitely the premium is going to be high on that policy, yes or no? And number two, if you say that after 10 years, within 10 years if something happens, you want at least 10 lakhs to be given to your family members. So capital sum assured means a minimum amount you want your family to receive, 10 lakh rupees. So 10 lakh confirm you are going to get, your family members are going to get. But if nothing happens to you, minimum 10 lakh you will get on your maturity, including bonus. For example, 10 lakh you will not get, you will get 11 lakh 20,000, 10 lakh 60,000. Some extra amount only will be given to you after the expiry of policy term as a maturity proceeds. Sum assured is final. 10 lakh policy you have taken, 10 lakh confirm you are going to get. But some extra amount also you will get, including bonus. But don't you think if the insurance company is going to give you that money after the policy gets expired, after 10 years, hello, the insurance company will be recovering that premium also? If not 10 lakh, but an amount near to 10 lakh only will be recovered by the insurance company in the form of what? Premium for over the period of 10 years. So the premium charged every year will be, for example, 85,000. 85,000 into 10. 8,50,000 will be recovered over a period of 10 years. Or the premium will be 90,000. Hello? 90,000 means 90,000 into 10. Pay 9 lakh over a period of 10 years. If nothing happens to you, minimum 10 lakh capital sum assured was there. You are going to get that. No, you are going to get more only. For example, you are going to get 11 lakh rupees. You paid 9 lakh and 2 lakh extra coming to you. That is good only, no? That 9 lakh which is going, that is coming back. The premium amount is coming back, and on top of that some extra amount is also coming back. But that extra amount is not too much, too high. A very small portion. So why to bloody charge tax on that amount? Forget it, no. Exempt it also. So that was the reason for the government to give this exemption for maturity proceeds, Because whenever the insured person is going to get the maturity proceeds, what will happen? He is going to get back his premium amount only, which he would have paid during these years. And some extra amount will come over a period of 10 years, 20 years, 30 years of policy. Let him have that some extra amount. No problem in that. Extra amount is a small amount, then no problem. What if policy maturity proceeds you are getting 15 lakh rupees, 12 lakh rupees, 13 lakh rupees. Now the extra amount coming is not a small amount, it is a big amount. Now this insurance policy is no more looked as an insurance policy, it is looked as an investment avenue, investment opportunity. So you took the policy not just to insure your life and get back the money coming you have already paid in the form of what? Premium. No, now you are investing, now you are paying the premium with an intention to make some investment so that you get some huge or good amount of returns out of that policy. And insurance companies also came up with such kind of policies, giving you huge benefits at the time of maturity. So they started taking a very less amount over a period of some time. And at the time of maturity, they used to give you huge returns, good amount of returns. Earlier, the returns were very less on insurance policy. Whatever premium used to go, that entire premium and a very small fraction of money used to come along with the premiums paid. So that time the insurance, that time the exemption was logical. But later on, slowly and gradually, these type of policies got popularity, and the insurance companies also offered, good amount of returns on such policies. Now the returns will not be the premiums paid by you. Hello, over and above, a small amount will not come. Over and above, a very decent amount will come. So now people started perceiving these type of policies as what? A mode of investment where they used to park their money. And after some time, that money grows and money will come. With this intention, government never gave this exemption. So what they did, with effect from 1st April 2003, they put one condition. What condition? That if you want your maturity proceeds to be exempt from the life insurance policy, whatever maturity proceeds are coming, if you want your maturity proceeds also to be exempt under section 1010D, then your policy premium should be paid within certain limits. Annual premium should be paid within certain limits. Beyond this, if the premium is paid for a single year also, then entire maturity proceeds will be taxable. Then it will not be exempt. Yes or no? So what condition they have put? If policy is issued or taken between 1st April 2003 to 31st March 2012, then maximum premium yearly, annual premium, maximum annual premium I'll write, on that policy cannot be more than 20% of capital sum assured. So whatever was the capital sum assured on that policy, capital sum assured means the minimum amount which the insurance company guarantees that this amount minimum you will get or your family members will get on your death. So that capital sum assured, 20% of that should be paid every year as your premium, not more than that. If the policy is taken between 1st April 2003 to 31st March 2012. So right now in 24-25, you are getting some maturity proceeds from a life insurance policy which was taken between this period. That maturity proceeds will be exempt in this year only if the yearly premium of that policy for every year was within the range of 20%. If every year the premium paid was 20% or less, 20% or less, 20% or less every year, then right now the maturity proceeds which are coming now will be fully exempt under section 1010D. Now with effect from 1st April 2012, okay, this limit was increased. 1st April 2012 to 31st March 2013. Not increased, it was indeed decreased. 10% of capital sum assured. Now the premium on such policy cannot be more than 10% of capital sum assured. If for any year during the term of the policy, for a single year also the premium is more than this 10%, then the maturity proceeds, whenever the maturity proceeds will come, will not be exempt under 1010D. Will you remember this? Now what if the policy is taken on or after 1st April 2013? Then also the limit is 10% of capital sum assured. But the limit will be 15% of capital sum assured in case the insured person is 80DD or 80DDB. Meaning the person whose insurance is taken, that person is suffering with certain disabilities as specified in 80DD. Or that person is suffering from some diseases or ailments which are prescribed in, specified in 80DDB. So if the person whose policy was taken happens to be handicapped or severely ill person, yes or no? Suffering from disabilities as specified under 80DD, handicap. Suffering from ailments, diseases specified under 80DDB, means severely ill. For such a person, if the policy was taken on or after 1st April 2013, then the premium will be 15%. Then the limit on the premium should be 15% and not 10%. Getting my point? So you have to see that right now whatever maturity proceeds are coming to you from a insurance policy, if you want to exempt that maturity proceeds right now, you have to see that when the policy was taken. So you will come to know that policy was taken between these dates. Then you have to remember that what percentage of premium should be paid. How much maximum premium on that policy should have been paid. If the policy was taken on or after 1st April 2013 and that policy is getting matured right now, how much premium, annual premium should have been paid? 10% or 15% as the case may be of the capital sum assured. Every year the premium on that policy should have been this much or less, this much or less, this much or less, and then you are getting the maturity proceeds, then it will be exempt under section 1010D. Will you remember? Hello sir. Even for a single year the premium was higher than the limit, maturity proceeds will not be exempt. Will you remember? Now wait. Here no, there is an amendment in the last year. If the policy is taken on or after 1st April 2023, so for that policy maximum limit was 10% or 15% of capital sum assured. That is still there. Because see, the policy is taken on or after 1st April 13 only, no? If the policy is taken on or after 1st April 23, meaning the policy is taken on or after 1st April 13 only. So whatever the limit which was prescribed, 10% of capital sum assured, 15% of capital sum assured, that is going to remain. But additionally, one more limit in terms of amount has been given now. And what did I say? And less than equal to rupees 5 lakhs. Earlier this rupee limit was not given. So if your policy was for 10 crores, if your policy was for 10 crores and the policy was taken during this period, come on, how much should be the maximum premium? 10% of 10 crores is 10% of 10 crores is 1 crore or less. So annual premium is 1 crore or less. Every year 1 crore less, 1 crore less, and whatever maturity proceeds coming, fully exempt. There was no limit, monetary limit, amount limit, percentage limit. If the policy is taken on or after 1st April 2013, the amount of policy, amount of capital sum assured was 1 crore 20 lakhs. So the yearly premium should be 12 lakhs or less, 12 lakhs or less. And if the policy was for handicap, then 15% of 1 crore 20 lakhs. Yes or no? So what is the 15%? 18 lakhs only. 18 lakhs, I guess. 1 crore 20 lakhs into 15% will be 18 lakhs. 18 lakhs should be the premium if the policy was taken on or after 1st April 2013 for a handicap. Every year 18 lakhs or less, 18 lakhs or less, 18 lakhs or less, meaning that amount can be any amount, but it should not be more than 10%, it should not be more than 15%. Now the bloody hell they have put a restriction on the amount also, that any policy which you are going to take which is issued on or after 1st April 2023, on that policy the yearly premium should be within the percentage range. Hello? Yearly premium should be within the percentage range, as well as that premium should not be more than 5 lakhs. Getting my point? What used to happen, I'll tell you. If you take a policy, the capital sum assured on the policy was 1 crore. And you take out that policy for a term of 10 years. Okay, 10 years term the policy is taken. Then the policy issued, for example, the policy is issued on or after 1st April 2013, meaning let us say in any previous year. Okay, no? For example, previous year 2021 the policy was issued. Date of issue of the policy was 1st of November 2020. Date of issue. So the policy is taken on or after 1st April 2013 only. And let us assume that the policy is taken for a person who is not handicapped, normal person. So how much should be the premium? Maximum premium should not be more than 10% of capital sum assured. Yes or no? What is that amount? 1 crore, 10% of 1 crore will be 10 lakhs. Okay. Now what the insurance company used to do, they used to take annual premium of only 8 lakhs. That is well within the range of 10 lakhs. Getting my point? And at the time of maturity, they promised that on maturity you are going to get 1 crore 5 lakhs. 1 crore 5 lakhs. When the maturity will happen? After 10 years, meaning 1st of November 2030, you are going to get 1 crore 5 lakhs. Now, if you will make some calculations, you will come to know that 8 lakhs per annum the company is taking from you, 8 lakhs per annum. So, in 10 years, how much amount you are going to pay? 80 lakhs only. That 80 will come back. In the maturity proceeds, that 80 will come back. Don't you think 25 lakh rupees extra will come back? Is it a small amount or a big amount? Even if they would have taken 9 lakh also, so 9 lakh into 10, 90 lakhs. 90 lakhs. That 90 is coming back, extra 15 lakhs is coming. That 15 lakh is a small amount or a big amount? Very big amount. Just imagine if 110 you increase in all these amounts. Policy 10 crores. Annual premium 1 crore. You are paying 90 lakhs. You are getting 10 crore 50 lakhs. Just imagine how much will be the amount, extra amount which you are going to get. So the high net worth individuals, those people who used to have huge sums of money, they used to park their monies in these kind of policies like this. So that even if small fraction of the return they are getting, but in terms of money, that amount used to be huge. And they used to keep the premium within the range only. And insurance companies also came up with such kind of policies to give such benefits, So what they did, if now the policy is taken on or after 1st April, see, for this policy, whatever maturity proceeds will be there will be fully exempt. Why? because the annual premium is within the limit of 1 crore. See, 10 lakhs. Sorry, annual premium is within the range of 10 lakhs. In terms of money, no absolute limit was given that your premium should not be beyond this amount. No, it was a percentage given. So see, no, the policy is taken honor after 1st April 2013. Premium should be 10% of the capital sum assured or less. So what is the 10% of capital sum assured? 10 lakh. And the premium paid is 9 lakh only. There was no monetary ceiling limit on the premium at that time. So on this policy, whatever maturity proceeds will come, 1 crore 5 lakhs. Now just see, 1 crore 5 lakhs, this 90 lakh will come back. 15 lakh extra will come back. Nothing will be taxable, fully exempt. 1010D. Are you getting this? This will be fully exempt under section 1010D. Now this same policy if you will take on or after 1st April 2023. Can you take the same policy? So let's see. Now what happens? Policy issued on or after 1st April 2023. Okay. So now what is the capital sum assured? Let's take 1 crore. What is the term of the policy? Example 10 years. See, the term can be any term. Term can be 15 years, term can be 20 years. For our, better understanding and for the simplicity of the calculations, we are taking 10 years only. Okay, no? So, term is 10 years. The maximum premium now the maximum premium on this policy should be 10% or 15% as the case may be. Yes or no? Because the policy is taken on or after 1st April 23. So that percentage limit is still applicable. Yes or no? So let's take the example that the policy is taken for a normal person only, not a handicap. If it was for a handicap, you would have taken 15%. Yes or no? So 10% of 1 crore is how much? 10 lakhs. And maximum amount of premium. Now the monetary limit is 5 lakhs. Now your policy premium should be 5 lakh or less. Only then these two conditions are fulfilled. So the actual premium which you are paying, no? Actual premium. If the actual premium on this policy is 5 lakh or less than 5 lakhs, then condition of 5 lakh will also be fulfilled and condition of 10% will also be fulfilled. Only then the maturity proceeds on this policy will be exempt. Getting my point? What if the premium paid by you on this policy is 8,50,000? Even though you are going to pay within 10%, but is the premium exceeding more than 5 lakhs? Now whatever maturity proceeds you are getting, no? Hello? Will not be exempt under 1010D. No. Amount wise limit is given now. So for example, the actual premium paid by you was 9 lakh rupees. Tell me, is this limit fulfilled? Yes. Is this limit fulfilled? No. So now whatever maturity proceeds on the policy you are going to get. How much you are getting? 1 crore. 5 lakhs you are getting. Are you going to get any exemption under section 1010D? Now this maturity proceeds, whenever you are going to receive, you are not going to get the exemption. So what will happen? This maturity proceeds will be taxable. Now wait. If you want to tax it now, because since it is not exempt under 1010D, the amount of maturity proceeds is now not exempt under 1010D. So now you are going to tax it. How much amount you are going to tax? Entire 1 crore 5 lakhs. If you will do that, meaning that the 90 lakh premium which is coming back to you, you are treating that also as your income. Should you treat that amount as your income? So don't treat that 90 lakh as your income. Whatever coming over and above that 90 lakh is your income. But wait. On this policy, no, every year some premium you would have allowed under ATC also. Out of 9 lakh premium which you are paying every year, no? Out of this 9 lakh, some premium you would have already claimed as a deduction under ATC. So that 9 lakh coming. So that premium is also coming back to you, no? Which we had allowed as a deduction under ATC. So first year how much premium you paid? 9 lakh. Out of that 1,50,000 is the limit under section ATC. So let us assume that out of 9 lakh, 1,50,000 premium you have already claimed as a deduction under ATC, because for the premium which you are paying every year, you are going to get the deduction also under section ATC. Yes or no? So how much premium was already allowed? Out of 9 lakh, 1,50,000 was already allowed, no, every year. 1,50,000 this year, 1,50,000 in the next year, 1,50,000 in the next year. Every year, 1,50,000 premium out of that would have been claimed by you as a deduction. Even that premium is coming back to you, no? Which you claimed as a deduction under ATC. That we are not going to reduce. We are going to reduce only that premium which we did not allow under the provisions of Income Tax Act. And out of 9 lakh, how much premium we did not allow? 7,50,000. That is coming back to you, that you reduce. But the premium which we already allowed you as a deduction, now that is also coming back to you. We will consider that also a part of your income now. Getting my point? So 1 crore 5 lakhs, what you are getting? Come on, tell me. 1 crore 5 lakhs, in this 1 crore 5 lakhs maturity proceeds, you are supposed to reduce the total premium paid during the term of policy which was not allowed as deduction under the provisions of Income Tax Act. Now tell me, total premium was 90 lakhs for 10 years. Out of that 90 lakhs, how much premium was already allowed in those 10 years? 1,50,000, 15 lakh was already allowed. Meaning that out of 90 lakh, how much premium was not allowed under the provisions of Income Tax Act? 75 lakhs. So that 75 lakhs of premium which you paid in the last 10 years, we have not allowed that under the provisions of Income Tax Act. That you reduce. That you are recovering, no? That you reduce. Over and above that, whatever recovery is there will be now treated as your income from other sources. Getting my point? So how much premium was not allowed? Out of 9 lakhs every year, 1,50,000 was allowed under section ATC, meaning 7,50,000 was not allowed every year. For how many years? 10 years. Because term of the policy was 10 years. So 75 lakhs out of 1 crore 5 lakhs, you reduce, the balance is 30 lakhs. Now can I say this 30 lakhs include this premium also which was allowed to you? And extra 15 lakhs also. Over and above 90 lakhs. Extra 15 lakhs also is included. And the premium which we allowed during the term of the policy which is now coming back to you, that also will be included in this 30 lakhs. Now this entire amount will be taxable as your income from other sources under a specific charge 56 subsection 2 clause 12. A new clause was inserted last year because there was no clarity about the taxability of this amount. They used to say that the maturity proceeds will not be exempt under section 1010D But they did not say, the law was silent that how much amount will be taxable every year. So now there is a clarity that whenever the policy is issued, see, the policy can be issued between this time, on or after 1st April 23, whenever the policy is issued, the yearly premium should be this much only. If the yearly premium paid is within this limit, then the maturity proceeds will be fully exempt. If the yearly premiums paid by you on these policies for a single year also is more than these limits which are given, yes or no, then whatever maturity proceeds you are getting, no, that maturity proceeds will not be exempt under 1010D, rather it will be taxable. And how much amount out of the maturity proceeds will be taxable? Entire maturity proceeds will not be taxable. Out of the maturity proceeds, whatever premium which is coming back to you will not be taxable, but we will reduce that premium which was not allowed to you under the Income Tax Act. During the term of the policy, whatever premium was paid by you, that is coming back to you, we will not tax, but that premium should be the premium which we did not allow you. Only reduce that premium which is coming back to you. So now your maturity proceeds will have amount in excess of premium, including that premium will also be now taxed as your income which was allowed under ATC during these years. Getting my point? Hello sir. Now capital sum assured is 1 crore. Now the higher value policies which you will take, and on those policies when you are getting higher sums as what maturity proceeds, those will not be exempt. That is the reason why this very small limit of annual premium is put. Now to avoid this, what the assessees will do, what they will do? Policy taken on or after 1st April 23 only, right? Capital sum assured, instead of taking one policy of 1 CR, I will take multiple policies totaling to 1 CR. Can I do it? 20 lakhs 5 policies, or 40 lakhs 2 policies, and 20 lakhs 1 policy. I can do any permutation combination, yes or no? So what I did, I took 25 lakhs rupees 4 policies worth 25 lakhs rupees. So instead of taking one policy for 1 CR, I have taken 4 policies. Okay, policy 1, policy 2, policy 3, likewise. So P1, P2, P3 and P4. 4 policies I will take now. Let's take an example. First policy is taken 20 lakhs. 20 lakhs. Second policy 40 lakhs. Third policy 15 lakhs. And the last policy 25 lakhs. Can I take? Hello? And now that entire amount of rupees, how much? 9 lakh of premium will be spread in these policies. Yes or no? 9 lakh was the premium for policy of 1 CR. Yes or no? So 9 lakh into 20 divided by 100, it will be 1,80,000 premium over here. So term of all the policies I will keep 10 years only. 10 years, 10 years, 10 years, 10 years, and the maximum premium, max premium limit is how much? Come on, tell me. In terms of percentage. In terms of percentage and in terms of rupees. Okay, no? In terms of percentage, it should be 10%. 10% of 20 lakhs will be 2 lakhs. Here it will be 4 lakh. Here it will be 1.5 lakhs. Here it will be 2.5 lakhs. In percentage terms, if the amount is calculated. Okay, no? And in rupee terms, it is 5 lakhs only. So this is the maximum range of my premium. My premium cannot be more than this amount. In percentage, this much amount, and in rupee terms, this much amount. So what I'll do, I'll pay the actual premium of 1.8 lakhs on this policy, 3.6 lakhs on this policy, okay, and 90,000 plus 90,000 plus 1.8 lakhs will be 2.7 lakhs, and on 15 lakh rupees of policy, wait, let me find out the amount. Yes, 1 lakh 35, 1.35 lakhs. 2 lakh 25. Into 100, 360, yes. Now can you total all the premiums? It is 9 lakh only. Can you total the capital sum assured? It is 1 CR only. Now instead of taking one policy of 1 crore on which you pay 9 lakh rupees of premium and getting the entire maturity proceeds taxable, you can do this. Now what was the maturity proceeds? 1 crore 5 lakhs, no? Now that 1 crore 5 lakhs will be spread in 4 policies. Yes or no? So the capital sum assured, the maturity proceeds which you are getting from here, I'll take some, imaginary amounts, imaginary amounts I'll take 20 lakh, 21 lakhs over here, I'll take 42 lakhs over here, I'll take 16 lakhs over here, I'll take 27 lakhs over here. So if you will total 21 plus 42 plus 16 plus 27, 26 I'll take rather. So it comes to 1 crore 5 lakhs only. Got it? Now just imagine what is happening. See, this maturity proceeds exempt. Why exempt? Because the yearly premium paid is within the limit. Yearly premium pays is within the limit. Yearly premium within the limit. Yearly premium within the limit. Tell me, this can be done? Even if you will do this, no, they will catch you. They are saying even if you are taking a single policy whose premium should not be more than 5 lakhs and multiple policies taken on or after 1st April 2023, their aggregate premium should also not be more than 5 lakhs. So if you want to claim the exemption out of few policies which you can take from here, because their premium should not be more than 5 lakhs. Yes or no? Aggregate premium. So can you take this and this? Look at the screen. Can you take the exemption of first two policies? No. Yearly premium will be more than 5 lakhs. 1.8 plus 3.6 will be more than 5 lakhs. So wait, you cannot take this and this, but can you take this and this? Yes, because the yearly premium is not more than 5 lakhs. Along with this, can you add this? 1.8 plus 1.35, 1.8 plus 1.35 plus 2.25, if you will add, it will be 5.4. So the third policy cannot be added. Only take this or this. Or do one thing, take this only. No policy. Take this plus this, 3.6 plus 1.35. It will be 4.95. You can take this and this also. So make any combination which you want. But the yearly premium of those policies taken together cannot be more than 5 lakhs. Getting my point? And the balance policies will be over and above this. Their maturity proceeds will not be exempt. See, you can claim the exemption for all the policies. Okay, no, 1010D is available for this also, this also, this also. For all the policies, maturity proceeds 1010D available. Yes or no? You can claim it from here also, you can claim it from here also, you can claim it from here also, you can claim it from here also. But we are not going to give you the exemption for all the policies. You can take in such a combination that their annual premium taken together in that term should not also be more than 5 lakhs. Single policy cannot be more than 5 lakhs, and all such policies taken together should not be more than 5 lakhs. Got it, sir? This was your life insurance policy. Will you be able to do it? Now what if you are taking the exemption of this? Hello, you are taking the exemption of this and this policy. So your this much amount will be exempt. Then the rest two amounts, last one and the first one, yes or no? That will not be exempt. That will be taxable. Okay, no? Or what you can do? You can take the exemption of this and this, yes. Then the two policies you cannot exempt. Make such a combination where you are getting the maximum benefit, maximum exemption, but the other policies will not be exempt. Got it, sir? Should I move ahead? So this was your life insurance policy. So this is only I have written over there. Please pay attention. See, tax treatment of life insurance policy. I want all of you to slowly read the entire part which is written over here. Slowly read it, everyone. The same thing I have explained now. Okay, so tell me, amounts received under the life insurance policies. See, the premium which you will pay now will be allowed as deduction under ATC. If you pay, then also allowed. Your employer pays, first make it your perquisite and then take the deduction under ATC. Yes or no? Forget about the premium. What about the amount which you are receiving? So either it will be a death benefit on any policy, fully exempt. If it is annuity, then taxable as income from other sources. If it is maturity proceeds, then it will be exempt under 1010D subject to condition. What are the condition? If the policy is taken between this period, the premium should not be more than this. If the policy is taken on or after 1st April 2012, the premium should not be more than this. If the policy is taken on or after 1st April 2013 for a person who is handicapped or suffering from specified ailments, then the premium should not be this much. Anyone will have a doubt, sir, what if the policy was taken prior to 1st April 2003? On those policies, there was no restriction on the amount of premium. So if right now some maturity proceeds is coming from a policy which was issued prior to 1st April 2003, full maturity proceeds will be exempt, whatever may be the premium which you would have paid. Because that time there was no limit on annual premium to claim the maturity proceeds as what? Exempt. Yes or no, sir? Now here only one more important thing they have added. Please pay attention. This one. This was the part which was introduced last year. Last year amendment came. What? Maturity proceeds including bonus if any on the life insurance policies issued on or after 1st April 2023 shall not be exempt under 1010D if the amount of annual premium or the aggregate amount of annual premiums on such policies exceed 5 lakh. Hence, the maturity proceeds of such insurance policies shall be exempt only if the annual premium paid thereon is within this limit of percentage and within this aggregate amount of 5 lakhs. Sure, sir? Now, this is for those policies which are issued on or after 1st April 23. So, they are saying the maturity proceeds of these policies will not be exempt. if the premium are not within these two limits. And for the earlier policies, the maturity proceeds will not be exempt if the premium is beyond this limit. Then what will happen? If the premium is paid more than this, for these policies, if the premium is more than the limits, or for these policies, if the premium is more than any of these two limits, then the maturity proceeds will be taxable. But the entire amount will not be taxable. Now new clause has been inserted, clause number 13, no sorry, clause number 12 in section 56 subsection 2, clause number 12 is inserted, and clause number 12 says any sum received including bonus under life insurance policy other than sum received under ULIP or Keyman insurance policy. We are not talking about the sum received under ULIP, we are not talking about the sum received under Keyman insurance policy, their taxability is different. So we are talking about the normal insurance policies, okay, no, which is not exempt under section 1010D. The amount received from the insurance company including bonus if any, which is not exempt under 1010D, meaning that the annual premium you would have paid more on that policy, hence the amount is not exempt under 1010D. Out of that maturity proceed, reduce the aggregate premium paid during the term of such policy to the extent not allowed under the provisions of Income Tax Act. Only reduce that premium which we have not given you as a deduction during the term of the policy. Reduce that premium. Whatever balance remained will be taxable as your income from other sources. Earlier, the maturity proceeds will be taxable like this. They had not given. So what the assessees used to do, assessees used to claim the entire premium paid during the term of the policy, including that premium which was already allowed to him under section 80C. He used to reduce that amount also. And the poor department had to allow that also, because there was no clarity about the taxability of maturity proceeds. Now they have clarified that maturity proceeds, this much amount will be taxable. Will you remember this? Sure. Perfect. Life insurance policy is over. Now we are going to talk about other policies. Come on, pay attention now. Medical insurance policy. Have you heard about medical insurance policy? Health insurance policy? Why do you take this policy? God forbid some hospitalization happens, okay, then all of a sudden the treatment cost will increase, the medicines cost will increase. So don't worry, the medical insurance company will take care of that because you have already covered yourself under the Mediclaim. Pay a small amount of premium. Be assured that whatever will happen, even if you are hospitalized, medical treatment expenses, hospital expenses, medicines expenses, pre and post hospitalization expenses for certain number of days will be covered by insurance company. For this, can I say this is paid? Medical insurance policy premium. Premium is an expense. That premium can be paid by assessee himself, or that premium which is an expense can be paid by employer of the assessee. Yes or no? If it is paid by you only, that is your expense, deduction is allowed under section 80D subject to conditions. Certain conditions are there, subject to those conditions it will be allowed under 80D. But if it is paid by the employer of the assessee, can I say it is a perquisite? Perquisite under the head income from salary? Yes, it is a perquisite, but sometimes this perquisite is exempt and sometimes it is taxable also. Exempt, sometimes it is taxable. When it is exempt, come on, tell me. If it is paid by employer, paid by employer for employee or employees, spouse, children, dependent, brother, sister, parents. Do you remember this thing we have already covered in income from salary chapter? If the employer is paying the medical insurance premium for these persons, then it is a perquisite, but it will be fully exempt. Nothing will be taxable. But if paid by employer for any other relative or family member of the employee, then the perquisite will be a taxable perquisite. Then it will not be exempt. Do you remember this? And for this, no. For this, deduction under section 80D cannot be taken. You have to pay the premium. Hello? You have to pay the premium from your taxable income on your own. You are not supposed to tell your employer to pay your premium. And if he is paying, is it getting exempt? Is it getting taxable? No, it is getting exempt. So the amount of premium which is getting exempt, how do we allow that amount to you under 80D? We are saying that it has to be paid out of your taxable income. Is the amount getting taxable for you? No. So there in 80D, no, I will link this point over there. Okay. That time you will come to know when it will be allowed under 80D, when it will not be. Majority of the cases it will not be allowed only, but only in single case it is allowed under 80D. That I will tell you. Even if paid by the employer, still it will be allowed. But in all the cases when the employer pays your medical insurance premium, it is not allowed as a deduction under 80D. Your medical premium you pay and claim under section 80D. Your medical premium paid by the employer, usually it is an exempt perquisite, hence not allowed under 80D also. Even if taxable, in some cases it is taxable also, no? Still it will not be allowed under 80D. Because for them, even if you pay, it is not allowed. Forget about payment by the employer. Even if you will pay for them, no, it will not be allowed under 80D. Getting my point? So I will connect this point with 80D. Don't worry about this. But right now, just remember this much. Now, will you receive the claim? Claim received on medical insurance policy? Yes or no? Not equal to income. Therefore, ignore. Whatever medical insurance claim which you are receiving, no, is not treated as your income under the Income Tax Act. Hence, ignore that amount. Did we discuss Keyman insurance policy? Yes. Did we discuss normal life insurance policy? Yes. Now we have discussed the medical insurance policy also. Remember this thing. Will you? Now, let's discuss about in your business or profession. Do you have stock and trading asset? Do you have stock and trading asset in your business or profession? So for that stock, for that trading asset, whatever insurance policy you have taken, can you pay the premium? That is your expense allowed as deduction under the head PGBP under section 36 subsection 1 clause 1. If you remember this, we have already done PGBP head. In PGBP head I have told you under 36 subsection 1 clause 1, any insurance premium for your stock, for your trading assets will be an expense allowed as a deduction under PGBP. So this you have already seen there. The moment you see it, no, it should immediately strike you. Okay, we have seen this. Okay, this is an expense allowable under PGBP. Now, will you receive the claim? Claim received. When you will receive claim? Claim received on damage or destruction of stock. So if your stock is damaged or destroyed, whatever stock is damaged or destroyed is your loss. This loss is also allowed as deduction under the head PGBP. Under which section? No section required, sir. Common sense required. Loss incurred in the course of business or profession is allowed as a deduction while calculating my profits. So against that loss which was allowed as a deduction under the PGBP head, whatever claim is received, don't you think that this claim is your deemed PGBP income under section 41(1)? I've already told you this. If some loss is allowed as a deduction, trading liability is allowed as a deduction, some expense is allowed as a deduction under the head PGBP. And against that, whenever you are getting some recovery, whenever you are getting some benefit, that recovery or benefit for you will be treated as your PGBP income, deemed PGBP income. Do you remember this? The same thing. Now, can you take another insurance? What type of insurance, sir? Possible. These are the assets used in your business or profession. For them also you are going to take insurance. So are you going to pay the premium on this policy? That premium is your expense which is allowed as deduction under the head PGBP under section 30 or 31. If it is for building, it will be allowed under section 30. If it is for plant, machinery, furniture, it will be allowed under section 31. Do you recollect these things or not? Now the policy claim is received. Now the claim is received on what? Damage, destruction of building, plant and machinery or furniture. The moment this is damaged, don't you think that this is a deletion from block? Whatever plant and machinery, building, furniture which is used in the business will be there in the block. So if they are damaged, they are destroyed, they are going away from the business, meaning going out of the block, no? So if the assets which were forming part of the block damaged or destroyed, going out of the block, against that what you are receiving? This claim. Can I say this claim is nothing but reduced from the value of block as what? As your deletion only. So whenever the assets will go, against that whatever money will come will be adjusted out of the block only, no? So assets will go, sold, assets will go. What will come? Selling price, adjust from the block. Assets are scrapped. Scrap value will come. So scrapped asset will go. Scrap value will come. Adjust from the value of the block. Assets are damaged or destroyed. Going out of the block. Insurance claim is received. So deletion happening. Insurance claim. Adjust from the value of the block. Hello, sir. This we have done in one question also in capital gains, if you remember. This was your last point. Done. Let's see. Read this part, and but last one point more. One more point. Wait. See, insurance policy of any personal asset known as capital asset. Possible or not? Now on this policy, whatever premium is paid, never allowed as deduction under the Income Tax Act, because no provisions in the Income Tax Act tells you to claim the deduction for such premium. So that premium cannot be claimed as a deduction, which is not allowed as a deduction. Hello, sir. And insurance policy can be received. Insurance claim will be received on what? Damage or destruction of such asset due to NRFE, if you remember. Then whatever insurance claim received will be treated as full value of consideration under section 45 1A. Because any damage or destruction of a capital asset due to NRFE, against that whatever insurance claim is received will be treated as your income taxable under the head capital gain as your full value of consideration under section 45 1A. Do you remember this? This was the last point. Okay, so see, we have discussed this, and we have discussed this. Please go through. I want all of you to read this. This is medical insurance. Stock in trade, trading asset used in the business. Please remember this. In the examination, these things are asked. Okay. You know this. We have already covered under capital gains under section 51. Okay. No discussion required. Now the most important part. Gift. This is very, very, very important. Okay. Pay attention now. See. I will ask you. You are going to give me the answers. Okay. We are doing section 56. Charging section, no? How many types of charge? General charge and specific charge. Specific charge 56 subsection 2 clause 1. Which income? Dividend. Clause 1b. Winnings. Don't look at that. No, not required. Clause 1, dividend. 1B, winnings. 1C, amount deducted from employee's salary as his contribution towards his staff welfare funds and schemes. Not taxable for me under PGBP, then I will tax it under IFOS. And that amount, if deposited in his scheme, in his fund on or before the statutory due date of that fund, of that scheme, then that amount will be allowed as a deduction under section 57 also. Then clause 1D, interest. Interest on securities, if not taxed under the head PGBP, will be taxed under the head IFOS. Then along with clause 1D, we did clause 8 also together. Interest on compensation or enhanced compensation on compulsory acquisition of a capital asset under any law. That interest is also taxable under the head IFOS. 50% standard deduction is given. Hello sir. Next one. Clause number 2. Rent from plant, machinery, furniture, if not taxable under the head PGBP, will be taxable under the head IFOS. Clause 3. Composite rent from letting out building along with plant, machinery, furniture, and both the lettings were inseparable, then don't separate the combined rent. Entire combined rent PGBP. If not taxable under the head PGBP, then confirm will be taxable under the head IFOS. Clause 4. Any sum received under Keyman insurance policy. If that sum is not taxable under the head salary as well as not taxable under the head PGBP, then that sum received including bonus if any will be taxable under the head IFOS only. Clause number 4 done. 5 is not there only. 6 is not there only. 7 is not there only. 7A, 7B not there only. Directly clause 8 comes. That clause 8 you have already covered with interest. Clause 9 talks about advance money received and forfeited in the course of negotiations for transfer of a capital asset, but the negotiations did not result into actual transfer. Actual transfer could not take place, and the advance money received is forfeited. On or after 1st April 2014, it is received and forfeited. Will not be adjusted under section 51 out of the cost. It will be taxable on receipt basis under the head IFOS only. 3 incomes: dividend, interest on compensation or enhanced compensation, and advance money received and forfeited. No method of accounting applicable. Dividend taxable as per section 8. Final dividend, income of the year in which it is declared. Interim dividend, income of the year in which it is actually received. Deemed dividend, income of the year in which distributed or paid, as the case may be. So dividend taxability will be like this only. Method of accounting will not affect the taxability. Yes or no? Advance money received and forfeited, always taxable on receipt basis. Method of accounting will not make any difference. Interest on compensation or enhanced compensation will also be taxable on receipt basis. Method of accounting will not affect. For all the other incomes, taxability will be based on method of accounting. Taxable on mercantile basis if regularly mercantile basis is followed. Taxable on cash basis if regularly cash basis is followed. Yes or no? Hello sir. These incomes so far we have seen. Clause number 9. Till clause number 9 we have seen, and we have also seen clause number 12. Maturity proceeds which is not exempt under 1010D will also be taxable under the head IFOS, but the entire maturity proceeds will not be taxable. Out of that you are supposed to reduce the amount of premiums coming back to you. Those premiums which you have paid during the term of the policy coming back to you, but which was not allowed as deduction under Income Tax Act during these years. Yes or no? Reduce that premium. Whatever balance will remain out of the maturity proceeds will be taxable under the head IFOS. Sure sir. So clause number 12 also we have covered. Now clause number 11 also I will speak. Then last point will be clause number 10, gift. Clause number 11, which says that if any sum is received by you as a compensation or any other by any other name. So any sum is received by you as a compensation on termination or modification of your employment contract, then usually it is treated as profit in lieu of salary, taxable under the head salary if it is coming from your employer. But what if the same amount, same compensation for termination or modification of your employment contract, your employer is not giving you, he makes some arrangements so that you get that amount from someone else. Someone else pays that to you on behalf of your employer. Possible or not? Then in that case the amount is not coming from your employer. It cannot be treated as your profit in lieu of salary. If the amount is coming from your employer, then only it will be treated as your profit in lieu of salary, your income under the head salary, no. But what if your employer makes some arrangements and as a result of those arrangements, somebody else is paying that amount on behalf of your employer. For example, I am supposed to give 10 lakh rupees to your employer. So what your employer says? That Umang, don't pay me 10 lakh rupees. Rather, my employee, this is my employee whose employment contract I have terminated, whose employment contract I have modified. I want to give him a 10 lakh rupees of compensation. So you paying me 10 lakh directly, pay that amount to my employee. It is as good as paid to me. Getting my point? So you are an employee. If you would have got that amount from your employer, then it would have been your income under the head salary because it would have been your profit in lieu of salary. Yes or no? But what if I am giving you that amount? Am I your employer? No. But that amount is received by you for as a compensation for termination or modification in your employment contract. Is your employer giving you that amount? No. I am giving you that amount. Am I your employer? No. So will this amount be taxable for you under the head salary as your profit in lieu of salary? No. Then don't worry. That amount will also be taxable under the head IFRS. Clause number 11. Will you remember this much? Sure. Perfect. Now coming to clause number 10. Five cases I will say. How many cases? 5 cases. First case. Sum of money received during the previous year without consideration. So you are an assessee. You are an assessee. You can be any person. Huh? So the gift provisions are not necessarily applicable on individuals or HUFs. Earlier it used to be applicable only if it is received by individual or HUF. But no, from last few years, the gift provisions are applicable for all the persons. So if you are a person, are you receiving any sum of money? Without consideration? At any time during the previous year? So whatever sum of money which you have received during the previous year without consideration, aggregate of all those sum of monies. So the sum of money received during the previous year without consideration, if that aggregate sum of money is more than rupees 50,000, then the entire aggregate sum will be treated as your income and taxable as gift under section 56 to 10 under the head IFOS. Amount in excess of 50? No. Entire aggregate amount will be treated as your income. For example, one of your friend is coming to your birthday, he is giving you 20,000 rupees cash, sum of money as a gift. Without consideration, you are getting 20,000 from your friend on your birthday. This same year, you are going to celebrate your you are going to celebrate your marriage anniversary. Not your marriage anniversary. And on the occasion of your marriage anniversary, one of your friends gave you 30,000 rupees. So one friend during this year gave you 20,000. Another friend, he gave you 30,000. Okay. None of them gave you more than 50. But both of them gave you sum of money without consideration, yes or no? Now one of your friends is also coming to your birthday. He is also giving you 10,000. None of them is giving you more than 10,000. Sorry, more than 50,000. But if you take the sum of money from all of them without consideration, now see all the sum of money coming to you during the previous year, aggregate of that. What? Aggregate of that. How much is that? 20,000 plus 30,000 plus 10,000 will give you 60,000. So this is the aggregate sum of money which you are receiving during the previous year without consideration. And what is the amount of this aggregate sum? 60,000. Is it more than 50? Entire 60,000 will be treated as your income, taxable as gift under the head IFRS. 56.210 applies here. Hello sir. Now why this provision was brought, you will be amazed to see. Earlier, no, in old days, when you were not born, that time I am talking about. I was also kid at that time. I was barely 10, 11 years old at that time. That time there used to be a law in India, Gift Tax Act. What? Gift Tax Act used to be there in India. As per the Gift Tax Act, no, the person who is giving the gift, the donor of the gift, there used to be a charge of gift tax on that person. So if you are a person giving gift to someone, you are a rich fellow. If you can, afford giving costly gifts to someone, so you should be, in a position to pay the gift tax also to the government. So the government used to charge gift tax from the person who used to give the gift. But majority of the cases, no, government was not aware only that what type of gift is given by whom to whom. Hello. So whatever gift tax used to be collected in India, no, was just like peanuts. The entire department was opened, gift tax department. What was their role? What was their duty? To collect the gift taxes as per the Gift Tax Act, which was very, very, very small amount. So, in reality, there was no gift tax collection per se. And the Gift Tax Act was, a bullshit. So what the government thought, instead of having such kind of law, having a department to collect that kind of, taxes, we are not getting those taxes also. Scrap the entire law only. So the entire Gift Tax Act was scrapped. Right now there is no Gift Tax Act in India, but earlier it used to be. At that time, whenever you are paying gift to someone, you are a payer of the gift, you are the donor. At that time you used to pay, as a donor you used to pay gift tax. But there were many challenges. Gift tax revenue were not collected properly. There was very less collection of gift tax. So government abolished that Gift Tax Act. Now after the Gift Tax Act was abolished, the donor is not liable to pay any gift tax. And the person to whom the gift was given, for that person, such type of gift does not come every now and then. It is not a revenue receipt, it is a capital receipt. And until and unless the Income Tax Act does not say the capital receipt is not an income, not taxable, yes or no? So people got a golden opportunity to earn their incomes on the name of gifts. So what everyone started doing, everyone started taking their incomes on the name of gifts. If I am supposed to take 50 lakh rupees as an income from Kaushik, no, I used to tell him, make a gift deed and transfer that 50 lakhs as a gift to me. Nobody should, doubt at that time. Kaushik will say, sir, but I cannot give gift. I will tell him that don't worry, macha, Gift Tax Act is abolished. So you are not liable to pay any tax on that 50 lakh rupees which you are supposed to give me as what? Gift. Give me that 50 lakh rupees. And for you, sir, For me, it is not an income only. For me, it is a capital receipt. Under the Income Tax Act, capital receipt is not treated as income until and unless specifically made income and charged to tax. So what used to happen whenever there used to be a search and seizure at someone's house, someone's premises, income tax officers used to go and search. Huge amount of monies used to be recovered. And if they used to ask that from where you got this amount, this much amount of cash, everyone used to say, actually it was their income only, which they would have earned in cash, okay, but they would have, they always used to say that it is a gift given by one of my friend. This is a gift given by one of my relatives. This is a gift. So whatever income everyone used to earn, they used to hide. And whenever they used to get caught, they used to say that it is a gift. So that was the drawback of eliminating what? Gift Tax Act. And at that time, there were no provisions in the Income Tax Act charging tax on gift also. Getting my point? So then the government thought that let us bring back the Gift Tax Act. But if they would have brought back the Gift Tax Act, then it would have been bad. The people would have started, abusing the government. That bloody you only don't know whether to keep the Gift Tax Act or not. How will you run the country? Sometimes you say that the law is not good, you are scrapping it, and again after some time you are saying no, it was a good act, and again you are bringing that act. So there will be no confidence from the general public to the government, no. So Gift Tax Act once gone, it cannot be again brought back. So now what to do? To curtail such kind of transactions, what to do? So they came up with an idea that if the tax cannot be charged on the donor, the person giving the gift, it can definitely be charged on the person receiving the gift. So after few years of abolishment of Gift Tax Act, after few years under the Income Tax Act, under section 56, the gift tax provisions were brought for the first time. For the first time, the gift used to get taxed in the hands of recipient. And that time the provisions were different. Okay, single gift used to be taken. Single gift up to 25,000, not taxable. Any gift more than 25,000 will be taxed. So everyone who wanted to take a gift of more than 25,000, no, they used to take multiple gifts of 25,000. If I want to take 1 lakh rupees from you, then I will not take 1 lakh rupees at once. I will take 25,000, 4 payments of 25,000. Then they brought the concept of aggregate sum of money. Single gift will not be seen. Now all the gifts during the year, aggregate amount will be seen. Yes or no? Then people started avoiding that also. Okay, you will charge tax on aggregate sum of money. We will start taking the gift in the form of kind. So only the cash gifts are taxable, not the gifts in kind. So people started taking the assets in the form of gift. Instead of taking 10 lakh rupees in cash as gift and paying tax on that, take 10 lakh worth of asset. So gradually the assets also got covered here in the gift provisions. Okay. Now what people started doing? Okay, you are covering the assets also. If we receive something without consideration, then you will cover it, no? We'll take it for inadequate consideration. Then it will not be a gift. We'll purchase it for less consideration. Instead of taking some asset for free at 10 lakh rupees, the asset whose value is 10 lakh rupees, taking that free of cost, you will say that it is a gift. No. Buying the asset worth 12 lakh for 2 lakh is not a gift. It is asset bought for inadequate consideration. How can you say that it is a gift? So to avoid the gift provisions, the assessee used to do all those things. So even those things got covered. And earlier what used to happen? Only the individuals and HUFs who used to get the gift, only in their hands the gifts used to be taxable. So if Kaushik wants to take a gift, okay, gift of asset, gift of cash, so it will be taxable in his hands because he is an individual. So what Kaushik will do? Kaushik and his wife both will form a partnership firm. Both will form a company. And on the name of that company, on the name of that partnership firm, he used to take the gift. Now Kaushik will say, see, I am not taking the gift as in the capacity of an individual. Who is taking? This firm is taking. And you are saying that the gift is taxable only if it is received by individual or HUF. Yes or no? In this case, the individual is not receiving the gift. Firm is receiving the gift. Will not be taxable. So slowly and gradually, these provisions evolved. And right now, whatever mischiefs were done, all the mischiefs are, sorted out. And the gift provisions are given. All the gift provisions earlier, those clauses which you have not studied, no, clause 5, clause 6, clause 7 and all those clauses were there for the gifts earlier. Now all the clauses are eliminated and entire gift provisions are, clubbed under one clause, clause number 10. Yes or no? So now if you are any person, not just individual or HUF, if you are any person receiving sum of money during the previous year without consideration, then the aggregate sum of money received by you during the previous year, if that aggregate sum of money, amount of that aggregate sum of money is more than 50,000, then that entire aggregate sum of money will be treated as your income, which we will tax in the form of gift under the head IFOS. Sum of money means what? Money. It can be Indian currency also, it can be foreign currency also. If it is Indian currency, then there is no problem. But if it is in foreign currency, no, you will have to convert that amount into INR by applying the foreign exchange rates. So the date on which you are getting the foreign currency gift, no, as on that date, what was the exchange rate of that foreign currency? You have to apply that exchange rate as on the date of gift. By applying that rate, you are supposed to convert that foreign currency gift into INR. That amount you take as your sum of money. Sum of money necessarily does not mean hard cash. Hello? If someone is giving you a check of rupees 10 lakh, it is a sum of money only. If someone is transferring to your Google Pay account, it is a sum of money only. If someone is giving you bank draft, RTGS, NEFT, ECS, these are what? Sum of money only. Sum of money received in India, Indian income, will be included in the aggregate. Whatever may be your residential status, ROR, RNOR, NR, if the sum of money is received in India, it is Indian income, will be included in this aggregate sum of money. Yes or no? What if the sum of money is received outside India? It will still be included in the sum of money if your status is ROR. What if your status is RNOR or NR? It will still be included in the aggregate sum of money if received by non-resident or RNOR from a resident outside India. Then as per section 9, it is deemed to accrue or arise in India, if you remember. So this sum of money will include only Indian currency or foreign currencies also, foreign currency gift also. Hello sir, but that has to be converted into INR by applying the exchange rate. Yes or no? Will this include only currency gifts or gift of money received through check, bank transfer, NEFT, RTGS, ECS, Google Pay, Phone Pay? Every money which is given in any form will be included here. Okay, no? Remember, if the sum of money is received in India, then definitely included in this aggregate. Whatever may be your residential status, it is your Indian income. If the sum of money is received outside India, then also it will be included here if it is received by ROR. If you are ROR, receiving some gift outside India, receiving sum of money outside India, but what was your status? ROR. So whether you receive in India or whether you receive outside India will not make any difference. It will be included in the aggregate. Hello? But what if you are RNOR or NR? You are receiving gift outside India. But if that gift you are receiving outside India from a resident, then as per section 9, it is deemed to accrue or arise in India. That is also your Indian income. In the aggregate, that will also be included. Now check the amount of aggregate. Is it more than 50? Yes. Entire amount will be treated as your income. Taxable under the head IFRS 56 to 10 will apply. Hello, sir. Now to avoid this, what you would have done? You would have taken the assets. Without consideration, you can take the asset also, no? Hello. So, now the second case. Assets means specified movable assets received during the previous year without consideration. Which assets I said? Any movable asset or specified movable assets? Which assets are specified? You know that. Which can be treated as a capital asset in the hands of recipient. Only those assets gift will be taxable under the head IFOS which is received by the recipient as a capital asset. If you are a recipient receiving an asset which can be treated as your capital asset, only then that gift will be taxable for you under the head IFOS. So what type of movable assets you can have? You can have multiple types of movable assets. But all the movable assets are not your capital asset. Only these movable assets are treated as your capital asset. Yes or no? So for the person who is giving, it can be any type of asset. You are not supposed to bother about that person who is giving you. But as a recipient, if you are getting these assets, yes or no? After receiving these assets should be treated as your capital asset. Getting my point? So what type of specified movable assets? What type of movable assets can be treated as your capital asset? Only PJ Das. Paintings, jewelry, drawing, artwork, archaeological collections, sculptures and shares. Will you remember this? Now, received during the previous year without consideration. Wow. Then what you are supposed to do? You are supposed to take the fair market value of all such assets which you have received during the previous year and aggregate fair market value. For a single asset, what is fair market value? No. For all the assets which you have received during the previous year. All the specified movable assets which you have received during the previous year. Without consideration. Take the fair market value of all those assets and aggregate that fair market value. If the aggregate fair market value of all such assets is more than rupees 50,000, then my dear friends, copy and paste. What will you do? This entire aggregate fair market value will be treated as income taxable under the head IFOS. So what if one of your friend is giving you jewelry and the value of that jewelry is 50,000? Will it be taxable under the head IFOS? 50,000? No, even if it is 50, will not be taxable. It has to be more than 50. 50 or less, not taxable. So one friend gave you jewelry worth 50,000. That is the only gift which you are receiving during the year. Come on, tell me. Will it be taxed? No. Single asset is also not more than 50. And the aggregate of all the assets during the year is also not more than 50. Hello? What if this gift, the jewelry given was 40,000 only? then also not taxable. But in that same previous year, one other friend gave you 20,000 rupees of 20,000 worth of shares also without consideration. So during the year, you are receiving two specified movable assets without consideration. One is jewelry worth 40,000 and another one is shares of 20,000. What is the total amount? Total fair market value of these two assets received during the previous year without consideration, 60, no? Is it more than 50? Yes, entire 60 will be taxable. Now I will try to confuse you. One friend gave you 40,000 worth of jewelry and another friend gave you 35,000 worth of cash. Taxable or not taxable? One friend gave you 40,000 of jewelry, specified movable asset without consideration. Another friend gave you sum of money, cash, 35,000 without consideration. Tell me, are these two gifts taxable under the heads IFRS or not? T for taxable, NT for not taxable. Come on. Whenever you will apply that 50,000 limit, no? Whenever you will do aggregate only sum of money separately. Apply 50,000 limit separately. Aggregate the fair market value of the assets received without consideration. Aggregate separately. Apply 50,000 limit separately. Don't aggregate sum of money and assets together. Because 50,000 limit is separate. For aggregate sum of money, 50,000 limit separate. For aggregate fair market value of the asset without consideration, the 50,000 limit is separate. And if you will add both of them, there will be a blunder. It will be wrong. Even if both taken together is more than 50. But for both of them, separate limit of 50-50 is available. Then why are you aggregating? If you want to aggregate all the sum of money. Take a separate limit of 50 on that. If you want to aggregate the fair market value of all the specified assets without consideration. Aggregate this fair market value separately. Getting my point? On this, apply 50,000 separately. Don't mix these two assets. The aggregate 50,000 is not on aggregate of sum of money as well as the assets received. No. 50 separate, 50 separate. Now whatever limit I will be telling you, those limits are also separate. So consider all the sum of monies separately. Consider all the assets without consideration, their fair market value separately. Don't mix them. Okay? Will you remember? Now, to avoid this clubbing provision, to avoid this gift provision, what you could have done? Instead of taking the asset without consideration, if you take the asset without consideration, they will come to know that it is a gift, no? So you want to take 10 lakh rupees from me. That 10 lakh rupees, I can give you this asset whose value is 10 lakh. Take this asset of 10 lakh. Don't give me any consideration. Will this entire 10 lakh be taxable? Yes, because it is more than 50,000. So now, to avoid this gift provision, what you will do? You will take another asset from me whose value is 12 lakhs. And you will give me 2 lakh for that. Net 10 lakh benefit happened to you, no? So instead of taking the 10 lakh like this without consideration, can you take 10 lakh for inadequate consideration? Yes, but it will not be treated as your gift. So to avoid this provision, you will buy the same assets for inadequate consideration so that the same benefit happens to you. And the gift is not charged in your hands because it is not a gift. You will say, I have purchased it. Something which comes without consideration only is my gift. No. Hello, sir. But under the gift provision, something which you buy for inadequate consideration will also be treated as your gift. So now what will happen? In the third case, you are receiving specified movable assets during the previous year for inadequate consideration. What is the meaning of inadequate consideration, friends? The fair market value of these assets which you are getting, which you are buying, is more than the consideration paid for that. So how much you are paying? Are you paying equal to fair market value or less than that? Less than that. Meaning you are buying the asset for inadequate consideration. Why are you doing it? To avoid this gift provision. If you would have taken without consideration, what would have happened? It would have been considered as your gift and it would have been taxable in your hand. To avoid this, you are doing this. Hello? So don't worry, we will consider this also as your gift. Now we will check what is the difference between the fair market value and the consideration. And the difference, all the assets which you are buying in the previous year, which you are taking during the previous year for inadequate consideration, the difference between the fair market value and the consideration for all such assets, aggregate of such difference, not only for one asset. For one asset, whatever difference was there. For the second asset, whatever difference was there. For the third asset, whatever difference was there. All the differences in the fair market value and the consideration for all those assets which you have acquired during the previous year for inadequate consideration, aggregate of all such difference is more than 50,000. Then, my dear friends, then this entire aggregate, what will you do? Copy and paste. This will be the entire difference will be treated as your gift. Even this difference difference between the fair market value and the consideration will be treated as your gift. During the previous year, you received shares. For example, you received shares of 45,000 without consideration. Taxable or not? This is the only gift received by you. No other asset received by you. Only this gift. Will it be taxable? No. Because the single asset coming to you, the value of that asset is 45,000. You are not paying anything. Without consideration you are getting. The value of this asset is less than 50 and no other asset is received during the year without consideration. Hello? So the aggregate amount of fair market value for this year is 45,000 only, which is the value of this single asset. Yes or no? Which is not more than 50,000. Hello, sir. Will it be taxable? Not taxable. But during the same year, you are buying shares also. The value of those shares was 5 lakhs. You are buying them from one of your friends for 3 lakhs only. Forget about 3 lakh. You are buying them from your friend for 4 lakh 40,000. What was the fair market value? What was the fair market value? 5 lakhs. Hello? And for what amount you are buying them? 4 lakh 40. Is the consideration paid by you 4 lakh 40? Is it less than the fair market value? Yes. How much is the difference? 60. Will it be taxable? Yes, this entire 60 will be taxable. Don't include this 45 along with this. For the aggregate difference, the limit is separate. Asset received without consideration, the aggregate fair market value, the 50,000 limit is separate. If the same shares you would have bought for 4 lakh 80, still it is purchased for inadequate consideration, the difference is only 20. Don't add 20 and 45. Hello, consider 20 separately and consider 45 separately. But wait, during the year you acquired shares whose fair market value was 5 lakhs. You acquired them for 4 lakh 80. So the difference is 20. Difference between the fair market value and the consideration is 20 only. Yes or no? Will it be taxable? No. But during the same year, some jewelry also you are purchasing. The value of that jewelry is 10 lakhs. You are purchasing them from 9 lakh 50. Purchasing for inadequate consideration only, no? How much is the difference? 50. Now this 50 and 20 you can add. You have to add. Because whatever is the difference between the fair market value and the consideration of those specified movable assets received by you during the previous year for inadequate consideration, whatever is the difference between their fair market value and the consideration, all such differences you are supposed to add. Aggregate of such difference should be more than 50. So tell me, shares you bought for 950. What was the fair market value? 10 lakh. Difference is 50. Hello? Sorry, jewelry. Jewelry you bought 10 lakh rupees. Fair market value was 10 lakh and you bought it for 950. What was the difference? 50. Shares. Fair market value was 5 lakh. You bought them for 480. So the difference is 20. So how much is the aggregate difference? 20 plus 40. 20 plus 50. It is 70. Total is more than 50,000. Entire 70,000 will be taxable. Will you remember this? Even that is treated as your gift. Even if it is not without consideration, even if it is for inadequate consideration, still the difference will be treated as your gift and it will be taxable if the aggregate amount of that difference is more than 50,000. Sure, sir? Hello, sir? Should I move ahead, sir? Next one, sir. Now, is it necessary that you will get only specified movable asset as capital asset? Can you receive immobile property? Can you? That is also a capital asset, no? So, during the previous year, immobile property, meaning any land or building or land and building received during the previous year without consideration, then aggregate stamp duty value. Don't do the aggregate. Take the stamp duty value of individual immobile property. Here you are not supposed to do any aggregate. Each single property received during the previous year whose stamp duty value was more than 50,000. So the entire stamp duty value, what did I say? Entire stamp duty value will be taxable as what? Gift. Because that stamp duty value is more than 50,000. Will you remember this? Don't aggregate here. You have to aggregate only in case of sum of money without consideration, only in case of specified movable asset received during the year without consideration. Fair market value of all such specified movable assets you aggregate. If that aggregate is more than 50, then the entire aggregate's fair market value will be taxable. But for immobile property, single immobile property received by you during the previous year for no consideration, without consideration, then whatever will be the stamp duty value of that property, if the individual stamp duty value of that individual immobile property was more than 50,000, then that entire stamp duty value will be treated as your gift. One immobile property you are getting, the stamp duty value is only 40. Another property you are getting, the stamp duty value is only 50. Tell me how much will be taxable? Nothing. Because for both of them, separately their stamp duty value is not more than 50. You don't have to aggregate here. If you will aggregate, you are gone. And right now, there is no property in India. Very rare you will find a property whose stamp duty value will not be more than 50. Yes or no? So only one property is sufficient. Okay, sir. What if a land you are getting and the stamp duty value of that land is 10 lakh rupees? Is it more than 50? Yes. Entire 10 lakh taxable for you as gift. Done, sir. Now, can you get the immobile property without consideration? Yes. Then it was considered as your gift. So, to avoid this, what you would do? You will purchase the stamp duty. You will show that you are purchasing, but actually you are not purchasing. You are trying to avoid this provision. To avoid this provision, you will purchase. You will show that you are purchasing. So definitely you are going to purchase for a consideration which is less than the stamp duty value only, no? For immobile properties, we always see stamp duty value. For other assets, we always see fair market value. Hello, sir. So can I say if immobile property meaning land or building or land and building received during the previous year for inadequate consideration. Inadequate consideration means the stamp duty value is more than consideration. Yes or no? Then we are supposed to take the aggregate difference. No, sir. Don't take aggregate here also. The entire difference on a single property. Hello? Check that this difference. If this difference is more than 50,000 or 10% of consideration, whichever is higher. Now don't compare the difference only with 50,000. Huh? In case of high value properties, always this difference will be more than 50 only. Just imagine a property you are purchasing, the cost of that property, the consideration for that property you are paying 9 lakh, 90 lakhs. Not 90 lakhs. Let's take an example. You are paying the consideration 95 lakhs. How much consideration you are paying? 95 lakhs. But the stamp duty value of that property is 1 crore. So is the stamp duty value 1 crore more than the consideration of 95 lakhs? Yes. What is the difference? 5 lakh. That 5 lakh will be treated as your gift. Why? Because it is more than 50. So in case of all such properties whose values are higher, the difference, even a small fraction of difference will be more than 50. So in every case, there will be a gift provision. Getting my point? Hello? So unnecessarily the assessees will be harassed in that case. So don't directly compare the difference with 50. Compare the difference with 50 or 10% of consideration, whichever is higher. With this higher amount, compare the difference. So what was the sale consideration? 95 lakhs, no? 10% of that, 9 lakh 50. So either 9 lakh 50 or 50, whichever is higher. So instead of comparing your difference with 50, compare your difference with 9 lakh 50. Don't compare with 50. Hello, sir. So is the difference 5 lakhs? Yes. Is it more than 9 lakh 50? No. Then there is no gift. Hello, sir. Nothing will be taxable. But what if the consideration was 90 lakhs? Consideration was 90 lakhs and the stamp duty value was 1 CR. Now what is the difference? 10 lakhs. Compare this difference with 50. No. Don't compare with 50. 50 or 10% of consideration. What was the consideration? 90 lakhs. 10% of 90 lakhs? 9 lakhs. So will it suitable to compare this difference with 50 or compare with difference with 9 lakh? Compare this difference with 9 lakh. Because 9 lakh is more than 50,000. Yes or no? Forget 50, compare the difference with 9 lakh. Is the difference more than 9 lakh? Yes, sir. Difference is 10 lakh. It is more than 9 lakhs. Now there is a gift. Entire difference will be treated as your gift, taxable under the head IFOS. Now what if the stamp duty value of the property is only 4 lakhs? Stamp duty value is only 4 lakhs. And the consideration is 3 lakh 30,000. 3 lakh 30,000 can be there, no consideration. What is the stamp duty value? 4 lakh. What is the consideration? 3 lakh 30. What is the difference? 70. Now the difference can be compared with 50. Because 10% of the consideration will be only 33,000. Now don't compare with 33, compare with 50. Is the difference 70,000 more than 50? Yes, entire 70 will be taxable as gift. Got it, sir? Difference up to 10% of your sale consideration we will accept. But if the difference is more than 10%, how do we accept? We don't accept it under capital gain and PGBP. Under 50C and 43CA also we don't accept this difference. Then for you, under the gift provision also we are not going to accept. Getting my point? Now, do you have to take this stamp duty value? What stamp duty value will take? Date of sale agreement, date of registration. Both the dates are not same. So SDV1 and SDV2. Two SDVs are given. We always take the date of registration. Always. But in one exceptional case, we take this also. If you remember. If as on the date of sale agreement, entire consideration or any part thereof you have paid to the seller, hello, by way of account pay check, account pay draft, prescribed modes, then whatever the stamp duty value which was there on the date of sale agreement, that only will be taken as stamp duty value for gift provisions also. And that also we used to take for 50C and 43CA. Do you remember that? Hello, sir. So same provision you are supposed to apply here. But remember, don't compare the difference only with 50. Compare it with 50 or 10% of sale consideration, whichever is higher. With that higher amount, compare your difference. If your difference is still more than this higher amount, no, then that entire difference, what did I say? Entire difference will be treated as your income taxable under the head IFOS. And the stamp duty value always on date of registration, as on date of sale agreement only if, as on date of sale agreement or prior to that consideration is paid by way of prescribed modes. Then take the stamp duty value as on the date of sale agreement. Otherwise take as on the date of registration. We have already done all these things. Sure, no? All the 5 cases of gift are over. These were your gift provisions. Will you remember? Sum of money received during the previous year without consideration. Aggregate of all such sum of money more than 50. Entire aggregate amount treated as your gift, taxable under the head IFOS. Specified movable assets received during the previous year without consideration. Aggregate fair market value of all such specified movable assets received during the previous year without consideration. Yes or no? If that aggregate fair market value of all such assets is more than 50, the entire aggregate fair market value taxable as gift. If the specified movable asset received during the previous year, hello, for inadequate consideration, and the difference between the fair market value and the consideration, that difference is more than, aggregate difference of all such assets received for inadequate consideration. If that aggregate difference is more than 50, entire aggregate difference treated as your gift, taxable under the head IFOS. Okay. If an immobile property received during the previous year without consideration and the stamp duty value of that individual immobile property, no need to aggregate, stamp duty value of that individual immobile property is more than 50,000, then the entire stamp duty value treated as your gift, taxable under the head IFOS. If the immobile property is acquired or received during the previous year for inadequate consideration, meaning it is received for a if it is received for a consideration which is lower than the stamp duty value is more than the consideration, then the difference between the stamp duty value and the consideration of that individual property, if that difference is more than 50,000 or 10% of the sale consideration, whichever is higher. Hello. So take the 50,000 or 10% of sale consideration, whichever is higher. Compare the difference with this higher amount. If the difference is more than the higher amount, entire difference will be treated as your gift, taxable under the head IFRS. Will you remember this? Sure, everyone. Now, the cases which I will tell you, in those cases, please don't apply gift provision. Whatever we have studied under the gift provision, nothing will be applicable in these cases. Yes or no? So key to remember is I am Dr. Hatlo, COVID-47. Hatlo means be aside. Hello, you are on my way, be aside. Please leave my way. So in Hindi we call it Hatlo. Hindi we call it what? Hatlo. So this is the key to remember those exceptions. Okay. I am Dr. Hatlo, COVID-47. COVID-19 was there, no? No, for us it is COVID-47. Okay. We'll remember like this only. So all these exceptions which are there in these situations, 56 subsection 2 clause 10, none of the provisions of 56 to 10 will be applicable. So these are exemptions. These are exceptions to the provisions of gift. One by one we will discuss them. I stands for inheritance or will. If you are receiving something, any cash, any asset, you are receiving on inheritance or will, under a will, then not covered by gift provisions. Whatever may be the amount, whatever may be the value, it will not be covered by gift provisions. Why? Because you are receiving that sum of money, asset, etc. under a will or by way of inheritance. So, I for inheritance or will. Okay. M for marriage. Now please be very careful. Marriage of the assessee himself. So on your marriage, you are receiving something, anything, whether you are receiving sum of money or you are receiving any asset, you are receiving from your relatives, you are receiving from your colleagues, you are receiving from your employer on your marriage, on the occasion of your marriage, whatever you are receiving, sum of money, asset, anything, okay, and whatever may be its value, 5 lakh, 10 lakh, 50 lakhs, crores, will not be covered by the gift provisions. Sir, is it received on the first marriage? Do as many marriages as you want. If you can marry for twice, no problem. Whenever you will get married, okay, at the time of your marriage, on the occasion of your marriage, whatever you are getting will not be covered by gift provision. See, marriage is covered, not the marriage anniversary. If you are receiving anything on your marriage anniversary, that will be taxable. Marriage is different, marriage anniversary is different. Marriage happens once, marriage anniversary comes every year. Just like death happens once, death anniversary comes every year, no? Like that only. Getting my point? Okay. Now, D for death contemplation of the payer. If some person is about to die, he is lying on his deathbed, his last wish is to give you something. My uncle, okay, not my real uncle, but very, far away relative, he was supposed to die. Okay, he is lying on his deathbed. All of a sudden, he remembered me. That okay, there is one of my nephew known as Umang. Let me call him. He does not have any children. He does not have anyone around him. But he has made a lot of money, made a lot of property, huge businesses, too many investments and all. So what happens now? While dying, he wants to give some of his properties, assets, bank balances, etc. to me as his last wish. So the person who is contemplating his death, he thinks that he is about to die, and if he will die, the asset will be given to Umang. The sum of money will be given to Umang. So as his last wish, whatever he is giving me is something received by me in contemplation of death of the payer. This also will not be covered by gift provisions. Anything, any value, okay, will not be covered by gift provisions. Okay. I for inheritance or will. M for marriage of the assessee. D for death contemplation of the payer. Okay. And R means relative. So, if you are an individual, assessee is an individual. So, if assessee is receiving something, whether he can receive sum of money or he can receive asset with consideration, without consideration, will not be covered by gift provisions. If it is coming from relatives. Coming from whom? Relatives. Now, who will be the relative for the assessee? Number 1, spouse. Whose spouse, sir? Your own spouse, huh? Other spouse is not your relative. Your own spouse has to be your relative. Spouse of such individual. Then number 2, brother and sister of such individual. Number 3, brother and sister of spouse of such individual. Number 4, brother and sister of parents of such individual. Number 5, lineal ascendant and lineal descendant of such individual. Number 6, lineal ascendant and lineal descendant of spouse of such individual. And number 7, spouses of 2 to 6. So the persons whose name are written in 2 to 6, the spouses of those persons also are my relative. So for you, your spouse is a relative. Your brother and sister, relative. Okay. The brother and sister of your spouse also your relative. Brother and sisters of your parents, meaning your uncle and aunties, okay, no, they are also your relatives. Remember, Brother and sister of your spouse's parents, they are not your relative. Only your parents, brother, sister, your relative. Okay, no? Your lineal ascendant, your lineal descendant. What is the meaning of lineal ascendant? Your generations coming before you, your ancestors. Okay? Your father, grandfather, great grandfather, they are your lineal ascendants. Who are your lineal descendants? Your children, their children, grandchildren, great grandchildren. They are your lineal descendants. They are your, generations after you. So, lineal ascendant of the individual, lineal descendant of the individual. Even the lineal ascendants of the spouse, even the lineal descendants of the spouse, they are also your relatives. Sir, lineal ascendant for me and my spouse will be different. That I understood. They cannot be same, no. Otherwise, you are not husband and wife. They cannot be same. Hello, my and my spouse, lineal ascendant will not be same. They will be different. Otherwise, we are not husband and wife. We are brother and sister with the same lineal ascendants. Hello? So, lineal ascendant will be definitely different. But lineal descendants will be same, no? My children are only my children. Or they are the children of my spouse also. Definitely. So, lineal descendants, normally they are same. But in case of second marriage, remarriage, the children of my spouse are different from first marriage. They are my stepchildren. Hello? So can they still be treated as my relative? Yes. Because they are lineal descendant of my spouse. Hello, sir? So lineal descendant of my spouse are also my relatives. Provided they are different. Okay? From first marriage, etc. And spouses of all the persons written from point number 2 to point number 6. Why not covered point number 1, sir? Good question. Who will be the spouse for my spouse? I will be only, no? So don't cover myself. Point number 2 to point number 6. My brother and sister are my relative. Their spouse is also my relative. The brother and sisters of my spouse, they are my relative. Yes, their spouse is also my relative. Brother and sister of my parents, they are my relatives. Yes, but their spouse is also my relative. My lineal ascendant, my lineal descendant, they are my relatives. Yes, their spouse is also my relatives. Lineal ascendant, lineal descendant of my spouse, they are my relative. Yes, their spouse is also my relative. Getting my point? From my point of view, they are my relative. But it is not necessary that from their point of view, I will be their relative. Just imagine, my uncle, for me, he is my relative. My uncle, my father's brother, is he my relative? Yes. So if I get something from him, not taxable for me. I am getting it from my relative. But if he receives something from me, it will be taxable for him. Why? Because for him, for that individual, his brother's son will not be his relative. If you consider your uncle, for you, your father's brother is your relative. But for him, his brother's son is not a relative. Relative definition does not cover. Getting my point? So from your point of view, you are supposed to see. From the recipient point of view, you are supposed to see them. If you are a recipient and you are getting any sum of money, any asset with consideration, without consideration from these persons, they are your relatives, nothing will be taxable in your hands. Whatever may be the benefit. Yes or no? What if the assessee is HUF? So assessee receiving something from the relative. So who will be the relative for HUF? Any member of the HUF will be treated as relative for the HUF. So if the HUF is getting anything from the relative, will not be covered by gift provisions. Because HUF is getting them from member means relatives. Opposite is also possible. Member is getting anything from relative. So for member, HUF is relative? Yes. For member also the HUF is relative. So for HUF, member is relative. For member, HUF is relative. Getting my point? If the assessee is any other person, assessee, any person other than individual or HUF. Receiving gift from relative, not possible. For them, there cannot be any relative. For company, there cannot be any relative. For firm, there cannot be any relative. For AOPBY, there cannot be any relative. Relatives are possible only in the case of individuals and HUFs. Yes or no? So can HUF say that I am getting this gift from my relative? Yes. But can a company say that I am getting this gift from my relative? Will not be taxable? No, company cannot say. For them, there are no relatives defined. There cannot be any relatives. Yes or no? So I for, come on, I for inheritance or will. M for marriage, on the occasion of marriage of the assessee. D for death contemplation. R for relatives. Okay. Now H, U and T. H means hospitals and medical institutions. What did I say? H means hospitals and medical institutions. U means universities and educational institutions. U means universities and educational institutions. T means trusts and charitable institutions. H means hospitals, medical institutions. U means universities, educational institutions. T means trusts, charitable institutions. And LO means local authorities. LO means local authorities. If you are receiving anything from them, not a gift for you, not taxable for you. Or they are receiving anything from anyone, for them also it is not taxable. So something received by them, not a gift for them. Something given by them, not a gift for the recipient. Because whenever they are going to give something, will be a help to someone. Whenever they are going to get anything, it will be a gift, it will be a help to them. So they are helping others or they are getting the help from others. How can that be treated as what? Gift. So any sum of money, any property, anything received by them will not be gift for them. If they are giving to someone, for that someone also it will not be treated as gift because it is treated as a help. And help cannot be treated as gift. Understanding? HUTLO. LO means local authority. Now COVID-47. What is the meaning of COVID? Have you heard about COVID? So there is COVID related ailments. COVID related ailments. Ailment means disease. So due to this ailment, who is suffering? Who is suffering due to this COVID related ailment? Either the assessee will suffer or any of his family member will suffer. Family member covers spouse, children, dependent brother, dependent sister and dependent parents only. Okay, no? So if the assessee himself is suffering or any of his dependent family members, spouse, children, dependent brother, sister, parents, they are suffering. So treatment of this ailment. For the treatment, expenditure needs to be incurred. And sometimes to meet such expenditure, the assessee will have to spend fortunes. We have seen that how much it used to cost to get the treatment done. Sometimes many of the families have not yet recovered from that loss. They have lost the people also and they have lost everything. Just to get the treatment done correctly, just to revive that patient, they have spent their entire earnings. They have sold their properties, etc. We are very fortunate that we have survived that COVID wave, you know. We are very fortunate. We should be thankful to God every single day. But we have seen those from our own eyes that people were, dying in the hospital. There was not enough money to pay for the treatment because all the money is lost, all the money is gone, all the properties, etc., bank balance, everything wiped out. Now, to save this person, treatment needs to be continued. For that continuity in the treatment, the money is required. Money is not there. What to do? So friends, families, and the people who knows me, they will come and they will help me for the treatment expenses. So to meet the treatment expenses of COVID related ailment, whatever amount is given, can I say that is a help, financial help? Can this financial help be treated as gift? Because this is also not received for any consideration. This is received without consideration. So something which you received without consideration, whatever money which you are receiving during the previous year without consideration, that has to be treated as gift. Many assessing officers charge this amount also as a gift in the hands of the assessee. Now that poor fellow got this amount as a financial help for the treatment of COVID related disease, and you are treating it as what? Gift. Gift provisions will not apply on this amount also. Hello, do you remember? So any financial assistance, any sum of money received for the treatment of COVID related ailments, yes or no, that will not be treated as gift, whoever giving it to you. But for that you have to provide the proofs that this amount was received by me for treatment of myself or my family members. See their prescriptions, see the COVID related disease has happened. Okay, no, so you'll have to submit the proofs. And if you are submitting the proof and against that you are getting this financial help, then there is no problem, it is not taxable. Yes or no? Sometimes due to COVID related ailment, a person dies and their family members also receive what? Financial help. Now this financial help can be given by employer of this person or any other person, any other relative also. Yes or no? Relative or the known person can help. So there is one person who has died because of COVID related disease. So after his death, he was the only bread earner at the house. He died. Now who will take care of the family? Children are studying. Wife is a housewife. She cannot do anything. She cannot go outside to earn anything. Parents are there. Who will take care of them? How the education of the children will be met? So that employer of that person, he comes forward and he helps. He provides some financial help to the family of the deceased person. Or some other relatives also will come and they are also going to give some financial help. See, from other persons, maximum 10 lakh rupees financial help is okay. From employer, any amount of help is okay. But this financial help should be received within 12 months from date of death. So within 12 months from the date of death of this person, if this financial help is received from the employer, any amount, or from any person up to 10 lakh, will not be treated as taxable amount as per gift provisions. This is also a financial help only. Yes or no? But for this also, the proofs should be provided. Death certificate, the reason of the death should be COVID related ailments and all. Yes or no? Based on this proofs, these things will not be treated as gift under the gift of provisions. Will you remember, sir? Hello? This is no more, that much relevant because now the COVID and all is gone. This was brought immediately after COVID, went. Because many of the assessments, the assessing officers were charging these amounts as what? Taxable amounts. So unnecessarily the assessees were getting harassed. Because many of the assessees would have got such kind of help and they would have shown that They would not have shown those things as their incomes. Getting my point? So they were being harassed. So the government immediately brought one notification. In that notification, this was provided. Understood, sir? Now, COVID 47. Do you remember 47.1? On partition of HUF, asset is transferred by HUF to member. So it is a taxable transfer for HUF or exempt transfer? Exempt transfer. So as per section 47, the transfer is exempt for the HUF. That does not mean that it will be a taxable gift for the member. For member, gift provisions will not apply. Getting my point? Now, do you remember holding to subsidiary? Subsidiary to holding. Hello? The transfer was exempt provided the subsidiary is a 100% subsidiary. Recipient company is what? Recipient company is an Indian company. The asset is not transferred in the form of stock in trade. So for the transferor company, the transfer is exempt. So that does not mean that for the transferee company, it will be treated as a taxable gift. It is out of the purview of 56(2)(10). Yes or no? Amalgamation takes place. So amalgamating company giving the assets to the amalgamated company, Indian company, in the scheme of amalgamation. Demerger takes place. In the event of demerger, the demerged company gives the assets to the resulting company, resulting Indian company. So that is a transfer exempt in the hands of transferor company under section 47. That does not mean that the opposite company will have to pay tax on that amount as gift under the head IFOS. For the recipient company, it will not be treated as what? Taxable gift under the head IFOS. I am Dr. Hatlo COVID 47. Will you remember all these transactions? Under any of these situations, whatever amount is involved, it will be outside the purview of Income Tax Act. Okay, outside the purview of gift provisions, not Income Tax Act, outside the purview of gift provisions. So no gift will be taxable in the hands of recipient. 56(2)(10) will not apply in the hands of recipient. Will you remember, sir? Sure. With this, the provisions of gifts are over. But remember one thing. Now, no. For example, I'll take the example of two parties. Okay, no? Mr. X is there and Mr. Y is there. Be very attentive because I'm mixing the provisions of capital gains also now. Done. Now Mr. X is giving, let's take one example of immobile property. Can we take the example of immobile property? Okay. So we are taking an example of immobile property. Okay. So this immobile property was given to Mr. Y without consideration. And the stamp duty value as on the date of giving was 10 lakh rupees. Possible or not? Think from the point of view of Mr. X and answer. What tax treatment do you recollect? X is giving his immobile property to Y for no consideration. Is there any consideration coming to Mr. X? So can I say X is transferring his capital asset by way of gift to Mr. Y? For X, section 47 will be applicable. Yes or no? And there will be no capital gain taxable. for Mr. X. Will you remember this? The cost of acquisition of this immovable property, no? For Mr. X, the cost of acquisition of this immovable property, Mr. X had acquired this immovable property, for example, for 6 lakh only. So he had acquired the property for 6 lakh in previous year 11-12. And in the previous year 24-25, this is getting transferred to Y. For at that time, the value of the property, stamp duty value of the property was 10 lakhs. So in 24-25, the transfer is taking place from X to Y. In 24-25, the transfer is exempt in the hands of Mr. X because it is transferred by way of gift. Section 47 covers. Hello? Now tell me, for Mr. Y, something coming, immobile property coming, and for Mr. Y, this immobile property is coming as his capital asset. In his hands, he should get this immobile property as capital asset. So is it a capital asset in the hands of Mr. Y? Yes. Coming from Mr. X? Yes. Now, I'll tell you one thing. If Mr. X is not a relative of Mr. Y, if Mr. X is not a relative of Mr. Y, can I say Y is receiving one asset, immobile property, without consideration from a person who is not his relative, and the value, stamp duty value of that asset is 10 lakh, which is more than 50,000. Gift provisions will apply in the hands of Mr. Y. Can I say 56-10 gift provisions will be applicable? And as per the gift provisions, what will happen? The entire stamp duty value, 10 lakh rupees, will be treated as his income taxable under the head IFOS. Entire 10 lakh rupees in the previous year 24-25 will be treated as his what? Income from other sources. On this 10 lakh, he will pay tax. Now, can you tell me one thing? Pay attention, pay attention. At what price Mr. X acquired? 6 lakh. So, till the time Mr. X was holding the asset, there was an appreciation in the value by 4 lakh rupees. Don't you think by taxing this 10 lakh rupees right now only in the hands of Mr. Y as his gift, that 4 lakh appreciation which was not taxed in the hands of X is now getting taxed in the hands of Y right now only with this 10 lakh rupees. Right now? So whatever appreciation happening from 6 lakh to 10 lakh will not be taxable in the hands of X. No problem. Because he is transferring the asset by way of what? Gift. But now that 4 lakh right now only in 24-25 only, that 4 lakh is getting taxed in the hands of Mr. Y. Because the entire 10 lakh value is taxed in the hands of Mr. Y. Hello, as his gift under the head IFOS. So that entire gain of 4 lakhs for the period of holding of Mr. X is already charged in the hands of Y by charging tax on entire 10 lakh rupees. Yes or no? Will you remember this? Now tell me one thing. At the time when the property came to Mr. Y, what was the stamp duty value of the property? 10 lakhs. Now can I say Mr. Y later on sells this property? So now, if later on above immobile property is transferred by Mr. Y. Let's say for example rupees 12 lakhs. In 12 lakhs only he is transferring. In September 24 and he got it without consideration in 24-25, no? So let's say he got it in April 24. So April 24 he got, and in September 24 he is transferring. For how much? 12 lakhs. Now can I say in the previous year 24-25 we will have to calculate his capital gains? Capital gains will now be calculated in the hands of Mr. Y. So to calculate that capital gain, we'll take full value of consideration, which is nothing but the selling price, 12 lakh rupees, minus transfer expense, no transfer expense. So the net consideration will be how much? 12 lakh rupees. Getting my point, everyone, sir? Now out of this 12 lakh, what will be the cost of acquisition? See, I'll give you three possibilities. Cost of acquisition will be taken as nil, because he got the property free of cost, no actual cost, nil. If nil is taken, no, entire 12 lakh will be taxed, and that 12 lakh is not a gain. We have to charge the gain over and above the cost of the property under the head capital gain. Yes or no? So if 12 lakh, if actual cost is taken, then it will be harassment to the assessee. So actual cost need not be taken. Do you know? We did something in capital gain. Mr. Y has acquired the property by way of gift. Mode specified under section 49(1). So whenever the asset is received by way of a gift, which is a mode specified under section 49(1), cost to previous owner is deemed to be the cost in the hands of the assessee. So we'll have to apply that. Here we'll apply 49(1). Cost to previous owner was 6 lakh. So if we'll reduce 6 lakh, 6 lakh will be the capital gains. Yes or no? Hello, sir. And we'll also include the period of holding of the previous owner. In my period of holding is April 24 to September 24. Hello. In my period of holding, the period of holding of the previous owner starting from 11/12 to 24/25, meaning April 24. 11/12 to April 24 is the period of holding of the previous owner, will also be included in my period of holding, meaning I will be taking the period of holding from the beginning, 11/12 to September 24. Based on this period, if the asset is short term, cost will be 49(1), no indexation. Hello. If based on this period of holding, asset is long term, indexation will be done, provided I have transferred prior to 23rd July. But in my case, I have not transferred prior to 23rd July. I have transferred in September. So no indexation will be done. Hello? But what if I would have transferred prior to 23rd July? Then indexation would have been given, but only for my period of holding. But if I would have applied the Manjula Ben judgment, indexation would have been allowed from the beginning only. Do you remember all these things? But don't you think if I apply 49(1) over here, what is happening, you know? That gain which was for the period prior to my acquisition, which has already got taxed in my hands, the moment it was taxed as gift, that gain is getting taxed for the second time here. Should I pay tax on that 4 lakh again? Or it should not be taxed again? The moment the 10 lakh is taxed to me as my gift, that 4 lakh is already taxed in my hands, no? So whatever was the period of holding of Mr. X, on that period of holding, whatever 4 lakh rupees gain was there, that was already taxed in my hands the moment 10 lakh got taxed in my hands under the head IFOS. So I should not be again paying tax on that 4 lakh under the head capital gains. And if I take this 49(1) as my cost, what is happening? I am again paying that tax on that 4 lakh. I am taking 6 lakh as cost. So from 6 lakh to 12 lakh, 6 lakh to 12 lakh, 6 lakh rupees of gain, I am paying tax again. Hello. The actual gain is 6 lakh only. Over and above 6 lakh, 6 to 12, total gain is how much? For my period of holding 2 lakh rupees of gain, and for the earlier period of holding 4 lakh rupees of gain, total gain is 6 lakh only. But out of that 4 is already taxed to me when 10 lakh got taxed in my hands. So now how much should be taxed? Only 2, no? So that 2 will be taxed if this is not taken as cost. 10 lakh is taken as cost, which is not as per 49.1, which is as per 49.4. This section I did not explain at the time of capital gains because I wanted to explain this with gift provisions. Now what is happening? If the gift provisions are made applicable to you, remember, listen to me very carefully. If the gift provisions are made applicable to you and the stamp duty value or the fair market value of that asset is already considered for the purpose of determining your gift income under the head IFOS, then always take a cost of that asset as per 49.4. Don't apply 49.1, because if you will apply 49.1, then the gain for the earlier period which already gets taxed in your hands under the head IFOS will again be taxed in your hands as your capital gains. If you don't want to pay tax on that gain again under the head capital gains, then don't take the cost to previous owner as per 49.1 as your cost. Always take 49.4. 49.4 will be applicable whenever the gift is getting taxable in your hands. Whenever 56,210 gets attracted in your hands. Hello? So now tell me, 2 lakh taxed under the head capital gains and 4 lakh automatically got taxed. Meaning your entire 12 lakh getting taxable in your hands. 10 lakh taxed under the head. 12 lakh gain, no, 0 rupees cost. Hello, 0 rupees cost. So 12 lakh is your entire gain. That 12 lakh should be taxable for you. Out of that, 10 is taxed as your IFOS and 2 is taxed as your capital gain. In that 12 lakh, 4 lakh rupees of gain happened during the period for which the asset was held by X. That is already taxed as your IFOS income. And 6 lakh more is taxed. Now over and about 10, whatever gain is happening, that should only be taxed. Meaning the gain happening for the period for which you are holding the asset, only that gain will be taxable. Hello? So gain from your period of holding, April 24 to September 24, only that gain will be taxable under the capital gain. Earlier gain is already taxed in your hands. Don't take the period of holding of the previous owner because you are not taking his cost as your cost. Don't take his period of holding. Take only your period of holding. Based on your period of holding, if the asset is short term, no need to index. Based on your period of holding, if the asset is long term, then give the indexation for your period of holding only. No Anjula Manjula applicable here. Anjula Manjula will be applicable only when 49.1 is applied. Are you applying 49.1? No. So take only your period of holding, and for your period of holding only, if indexation is available, take the indexation for your period of holding. And cost you are not going to take 49.1, take 49.4. Why are you taking 49.4? Because the gift is already taxed under the head IFOS. Hence you are taking cost as 49.4. Now I will take the same example, and I will twist one information and see the entire calculations will change. See, my favorite stuff, you all know what I like the most. Copy and then same example I am pasting over here. Okay, pay attention now. What information I will change, Only one. For X, no, there will be no change because X is making a taxable transfer. No, X is making an exempt transfer. For X, there will be no change. For X, there will be no capital gain arising because X is transferring without consideration. X is giving as a gift. Whether the opposite person For opposite person, Mr. X is a relative or Mr. X is not a relative will not make any difference to Mr. X. For Mr. X, the transfer is exempt. Hello? Now, whatever difference will be here, it will be here for Mr. Y. Is Mr. Y receiving the asset as capital asset? Yes. From whom he is receiving? From his relative only, no? So, are you receiving the asset whose value is more than 50,000? Yes. Should this entire amount of 10 lakh be taxed in your hands? The answer is no, because it is coming from your relative. So can I say now for Mr. Y, the gift provisions will not be applicable? And for Mr. Y, if the gift provisions are not applicable, can I say this 10 lakh will not be taxable in the hands of Mr. X? Sorry, in the hands of Mr. Y as IFOS? Meaning that 4 lakh rupees of gain for the period of holding of Mr. X, which should have been taxed as IFOS, is not taxed right now. That 4 lakh and the gain for your period of holding both should be taxed in your hands. Hello? When you transfer the asset as a capital asset. Yes or no? And that is possible only if you take 49.1 as your cost now. What will you take, friends? You will take 49.1 as your cost and not 49.4. So now how much will be taxable? 6 lakhs. This includes the gain for your period of holding 10 lakh to 12 lakh. 2 lakh also will be included, and the earlier gain of 4 lakh which was exempt in the hands of X and which could not be taxed in your hands as your gift, hello, will also be taxed right now. Tell me, what was the cost of the asset? 6 lakh. Over and above 6 lakh, how much gain is happening? 6 lakh. So that entire 6 lakh should be taxable right now? Yes or no? It is getting taxable. See. Now, why are you taking 49.1 over here? You are taking 49.1 over here because gift provisions are not getting applicable. So, in the hands of Mr. Y, if the gift provisions are not made applicable, then only take 49.1 as a cost, which we have already done in all the questions which we have solved. Hello? In our capital gains chapter, we were discussing this part only, because I never introduced gift provisions over there in the hands of recipient. If I would have done this at the time of capital gains, no, you would have left capital gains and you would have sit at home. No need to do capital gains, sir. Very tricky, very difficult. Now, did you understand everything? Now what you will do? Cost to previous owner you have taken as your cost, because you are receiving that asset by way of what? Gift, no? Mode specified under section 49.1. Now you take 49.1 cost to previous owner, because for you the gift is not taxable. So whatever gain happening for the period of holding of X not taxed in his hands because it was exempt under section 47, and it is not taxed in your hands also as your gift. So that entire 4 lakh rupees of gain and the gain happening for your period of holding, both the gain should be taxable to you. It is possible only if cost to previous owner is taken as your cost. Hello sir, 49.1 applicable. Cost to previous owner taken as your cost. Period of holding of the previous owner will also be included in your period of holding. Based on the total period of holding, if the asset is short term, then cost 49.1, no need to index. Hello? Based on that period of holding, if the asset is long term and the transfer made by you was prior to 23rd July, you will do the indexation also. But remember, indexation only for your period of holding. And now here you will apply Manjula Bain judgment also. Will you remember this? Sure. Case number 1. Okay. I copied. I pasted here. Now case number 3. Copy paste. Wait. Wait. What changes I am making now? You please see. What changes I am making. See, that same case I have copied over here. Okay. Now what changes I am making. See, without consideration, no, I will remove this word. Okay. In April 24, when the immovable property for rupees 8 lakhs in April 24 when the stamp duty value of the property was rupees 10 lakhs. Can I say this is without consideration or for inadequate consideration? Yes, when the value of the property was 10 lakh, at that time it was sold for 8 lakhs. So you are getting for inadequate consideration and he is transferring for inadequate consideration. Now he is getting the consideration. Now for Mr. X, the transfer will not be an exempt transfer. He is selling the asset. Now if you will say that transfer by way of gift, no, he is not gifting anymore. Now section 47 will not be applicable for him. Now what will happen? Now see, if Mr. X transferred such immovable property as what? Stock in trade or as a capital asset. If he is transferring as stock in trade or capital asset, then as per 43 CA or as per 50 C, stamp duty value is more than what? Consideration. Difference between both of them, 10 lakh minus 8 lakh, 2 lakhs. Yes or no? 2 lakhs difference. Is this difference more than 10% off? Is this difference more than 10% off? Consideration was 8 lakhs. 10% of 8 lakhs is 80,000. Is this difference more than 80,000? Yes. Now 50C or 43CA will be applicable, and for him full value of consideration under the head capital gain or PGBP will be how much? Will be 10 lakh. And based on this 10 lakh only his capital gain or PGBP income will be calculated. Yes or no? Now see, whatever gain happening from 6 lakh to 8 lakh, 6 lakh to 10 lakh. 8 lakh is not taken as his consideration. Yes or no? 6 to 10. His cost was 6 lakh. Check. 6 lakh to 8 lakh. No. Your gain is not 2 lakh. Your gain is 4 lakhs. Pay the tax on entire 4 lakhs. So on that 4 lakh rupees of gain, he has already paid tax. His capital gain will be calculated, full value of consideration 10 lakhs, his PGBP income will be calculated, PGBP income 10 lakh minus the cost under the capital gain or the PGBP minus the cost will be how much? 6 lakh. 10 minus 6, 4 lakh will be his gain. He will be paying tax on that entire 4 lakhs. Meaning that 2 lakh rupees less he wanted to show by showing the selling price of 8 lakhs. That 2 lakh rupees less he wanted to show, that 2 lakh is already taxed in his hands. Yes or no? Now it should not be taxable for you, but for you it will be taxable because you are also receiving that asset for inadequate consideration. Are you receiving that for inadequate consideration? Yes. Now for you 56(2)(10) will be applicable because he is not your relative. And from a person who is not your relative, you are getting one asset whose value is 10 lakh right now. You are getting it for 8 lakh. 2 lakh rupees benefit happening. Hello? That 2 lakh rupees is more than 50 or 80. Whichever is higher, 80. 80 will take, 8 lakh rupees is the sale consideration. 10% of that will be 80. So 50 or 80, whichever is higher, 80. So you check the difference of 2 lakh. Is this 2 lakh more than 80,000? Yes. In that case, the 2 lakh which already got taxed in the hands of Mr. X by increasing his selling price from 8 to 10, that 2 lakh extra which has already got taxed in his hands, now that 2 lakh will also be made as your income. Getting my point? So now what will happen? 56(2)(10) will be applicable to you and you are going to pay tax on that 2 lakhs. 2 lakh is the difference between 8 lakh and 10 lakh. That difference is taxable as gift for you because that difference is more than 50,000 or 80,000, whichever is higher. That difference is more than 80,000. So that entire difference of 2 lakh will now be taxable for you as what? As your gift. Now tell me, if this 2 lakh has already been considered as income for Mr. X, and if it is getting considered for you as your IFRS income again, this is taxability of 2 lakh twice, no? So if it already gets taxed in the hands of X and it is also getting taxed in your hands, so you should be getting the benefit of this 2 lakh at the time when you are transferring the asset. But right now you are also supposed to pay tax on this 2 lakhs. Don't worry, we are not going to charge the tax on this 2 lakh forever. Take this 2 lakh also as your cost. So whenever you will sell the asset for 12 lakhs, will you calculate capital gains? Yes. At that time, don't reduce your, now you will not take cost of acquisition 49.1 because you are not getting the asset by way of gift. You are purchasing the asset. So whenever you purchase the asset, what you take? Actual cost only you take as your cost of acquisition. No. So here you will take actual cost. Your actual cost was 8 lakh. So if you reduce 8 lakh here, what will be your capital gain, guys? Your capital gain will be 4 lakhs. Getting my point? Now see, if this 4 lakh is getting taxable for you, no? Meaning that the 2 lakh rupees gain which already got taxed in your hands as your IFRS, that is again getting taxed here. If that 2 lakh is already taxed in your hands as your IFRS, hello, by charging that 2 lakh as your gift under the head IFRS, 8 lakh was your cost, 2 lakh is treated as your IFRS, entire 10 lakh if you reduce here, so you will be charged tax only on the amount of gain happening in your period of holding. And we want to charge tax only on that. Right now pay tax on 2 lakhs under the head IFRS. But whenever you will sell the asset in the future, we are not going to charge tax on this 2 lakhs again at that time. Hello sir. So make this 2 lakh also as your cost and 8 lakh is anyways your cost. So what should be your cost? 8 lakh or 10 lakh? 10 lakhs. Which is nothing but the stamp duty value considered for gift provisions. Hello. Will now again be taken as your cost. This is also 49.4. So whenever the gift provisions are made applicable to you, can you see gift provisions are made applicable to you, and for the purpose of gift provisions, whatever stamp duty value was taken as per 49.4, take that stamp duty value or fair market value as your cost of acquisition. Getting my point? So how much will be taxable? 2 lakh. See, you bought the asset for how much? You bought the asset for how much? 8 lakhs. You sold it for how much? 12 lakhs. So total gain 4 lakh, no? Out of that 4 lakh, 2 lakh is already taxed as your IFRS. Now how much should be taxed? 2 lakhs. See, 8 lakh you bought, 4 lakh is your gain. Out of that 4 lakh, we have already charged 2 lakhs under the head IFRS. So now only 2 lakh should be taxed under the head capital gains, no? If we take 8 lakh cost over here, so the gain which is already taxed as your IFRS gift will now be again taxed in your hands as your capital gain. You want to pay tax on that 2 lakh twice or only once is sufficient? So pay tax on that 2 lakh at the time of gift. Whatever benefit over and above 8 lakh will be taxed as your gift. And over and above 10 lakh, whatever benefit will happen, that will be taxed as your capital gains. Understanding? Why did you take this 49.4? Because gift provisions got applicable to you. Did you understand this? Gift provisions made applicable to you, hence you took 49.4. But if the gift provisions are not applicable, you are not supposed to take 49.4. Now whenever 49.4 is applied, take only your period of holding. check your period of holding only. Hello sir, no need to include the period of holding of the earlier person. Now this same case, should I twist this? Small information. What information sir? Copy, and after copy what we do friends? Paste. Which information should I change now? Now it is only relative. For Mr. X, no, the treatment will not change. For Mr. X, 50C or 43CA will be applicable because he is selling the asset for a consideration which is less than the stamp duty value. Hello sir. For him the provisions will remain same. There is no change. Change will happen at the end of recipient. And why I am doing such efforts, you will come to know. Within some time you will come to know, because one question which we are going to solve, no, that question has this concept only. And now you will see that question will be so much easy for you, no, you cannot even imagine. If you will see the size of that question and if you will see the answer of that question, no, you will go mad. Oh my god, what is this question? And after doing this, when you will go to that question, no, you will see that how easy that question is. But I'll have to make these efforts, no, only then that question will be easier for you. Understanding? And since many years, since last 5-6 years, that question is there in the ICI study mat. It is getting very excited to come in the exam, but it has not yet come. So maybe your attempt is the lucky attempt and you are those lucky people getting that same question in the examination. What you will do if you don't know all these things? And nobody connects the capital gain provisions with the gift provision like this, the way in which I am doing it. This much detail is not required. Why not required? Bloody, they are asking you if these provisions are there in your ICI study mat, and if these provisions are there in your syllabus, they have to be taught. And if you are not learning, it is your loss. See, from the point of view of the transferor also you are thinking, and from the point of view of the transferee, that is the recipient also, from his point of view you are thinking. You never know in the examination whose point of view they are asking you. You think that gift provision applicable, but they are not asking you for the transferee, they are asking you for the transferor. You should be aware, no, that what is to be done for whom. Getting it or not? So now let's come to this part. If he is a relative, Mr. X is a relative. So for Mr. Y, don't you think that this gift provisions will now not be applicable at all? Now the applicability of gift provisions will not be there. Meaning that this 2 lakh which you were taxing here now under the head IFOS will now not be taxable at all. For you the gift provisions not. Now tell me, the asset which you bought for 8 lakhs, whose stamp duty value is 10 lakh, 2 lakh gain happening to you right now only. But is that 2 lakh taxed in your hands as your gift right now? No. So should it be taxed later on? Yes. 10 to 12, 2 lakh gain should also be taxed that time. And this time, whatever 2 lakh gain which should have been taxed to you, which is not taxed right now, even this 2 lakh should be taxed at that time. Entire 4 lakh gain should be taxed as capital gains. So for that, take the actual cost as your cost of acquisition. Hello sir, no 49.4 applied. Why? Because the gift provisions are not made applicable to you. So if the gift provisions are not made applicable, you are not going to apply 49.1. In the first case, hello sir, in the second case, and if the gift provisions are not made applicable to you, this fourth case, you are not supposed to take what? Stamp duty value. You are supposed to take actual cost. At what cost you acquired? 8 lakh. How much you sold it for? 12 lakh. How much was your gain? 4 lakh. That entire 4 lakh will now be taxable in the form of capital gain. But if the gift would have already been taxed, then also 4 lakh is taxable. But out of that 2 lakh tax right now in the form of gift, then later on only 2 lakh will be taxable. That we have already seen. Third example. Hello sir. Here we applied 49.4 and here we cannot apply 49.4. So what I will have to do? I will have to take the actual cost. I cannot apply 49.4. Now I will take 8 lakh as my cost of acquisition, everyone. So now my capital gain will be 4 lakh. I took the actual cost as cost of acquisition. I took the actual cost as my cost of acquisition. Why I did it? Because the gift provisions are not getting applicable in my hands. Hello sir, are you all understanding? Hence I took the actual cost as my cost. What will be your period of holding? It will be your period of holding only. No need to include the period of holding of the previous owner. Whenever 49(1) will come, no, that time only the period of holding of the previous owner you are supposed to include. That time only Manjula Bain and this and that you are going to discuss. Otherwise, don't even talk about those things. Got it, sir? These 4 points, will you remember? Now, I told you one very important thing. But you all know, you all don't, pay attention to the things which are important. I told you that if you are a recipient, okay, if you are a recipient receiving any asset, okay, no, that asset can be specified movable asset, that asset can be immobile property. So the asset can be either the specified movable asset, can I say PJ Das, or it can be immovable property. For the recipient, this asset must be a capital asset. So whenever the assets coming to you, they must come to you as your capital asset. Only then the provisions of gift will be applicable. What if the asset coming to you as your stock in trade? Gift provisions will not be applicable only. Because usually you buy these assets as your stock in trade for a lower price and you will sell it for a higher price, and whatever difference will be there, that entire difference you are going to charge under the head PGBP only, no? Selling price minus cost, which is a lower amount, the entire difference will get taxed under the head PGBP. Hello sir. What if Mr. A is transferring his jewelry, okay, jewelry whose fair market value was rupees 10 lakh right now, and he is transferring for a sale consideration of rupees 9 lakhs to Mr. B. See, if Mr. B is taking that jewelry as his capital asset, 1 lakh rupees is more than 50. Difference is 1 lakh rupees, which is more than 50. That 1 lakh rupees will be taxable for Mr. B as his gift, because he is taking that in the form of capital asset. But what if Mr. B is a jeweler? Will he take this jewelry as his capital asset, or he will take this jewelry as a stock in trade? For him, now the jewelry will come as a stock in trade. Now the moment he is taking that asset as a stock in trade, for him 56(2)(10) will not be applicable at all. 56(2)(10) gift provisions will not be applicable for him at all. Why, sir? Because see, even if 1 lakh rupees is taxed in his hands right now as what? As gift under the head IFOS, then he will pay tax under the head PGBP on the balance 1 lakh. For example, he is selling the same jewelry for 11 lakhs later on. So he will pay tax on 1 lakh under the head PGBP. That is going to happen very soon, no? Hello? So why to bloody bother about this person who is getting the asset in the form of stock in trade? Anyways, he is very soon going to sell that asset, and on that entire gain, very soon he is going to pay tax under the head PGBP. On the entire gain he is going to pay. But what if that asset came to him as a capital asset? Whatever gain happened now may not be taxable for a recent period. It might be taxed in some later on year, or may not be taxed at all. So it is better to charge that amount right now only under the head IFOS as what? Gift. So that is only if he is taking the asset as capital asset. Now as a capital asset, if this asset is coming, so on this 1 lakh, On this 1 lakh, you pay tax right now only in the form of IFOS income, gift. Maybe you never know on this 1 lakh, Mr. B, when he will pay tax now, because he is getting the asset as a capital asset. Might be he'll have this capital asset for a long period of time. Might be he'll never sell it. So at least on this 1 lakh, he pays tax right now. That is good, no? Hence, IFOS provisions made applicable to Mr. B if he is receiving that asset as capital asset. But what if he is getting that asset as a stock in trade? Don't you think he is going to sell this stock in trade very soon? So on the gain happening right now, from 9 lakh to 10 lakh, on this gain and the gain which will happen on the later on period, that entire gain anyways he is going to charge under the PGBP very soon, no? So what is the point of bringing him under the IFOS provision? Don't bring him under the IFOS provision. Provisions of gift not made applicable to him. Hello, sir. So now what will happen? Whenever Mr. B will sell his stock in trade jewelry for rupees 11 lakhs, at that time he will reduce the cost of rupees 9 lakhs. Simple. On this entire 2 lakh, the gain which is happening right now and the gain which is happening after he has taken the jewelry, 1 lakh plus 1 lakh, entire 2 lakh he is going to pay tax very soon under the head PGBP. If this entire 2 lakh we are charging him under the head PGBP, so there is no point of charging 1 lakh out of this under the head IFOS as his gift. Hence, whenever the asset received by the recipient, as his capital asset, only then the gift provisions are made applicable to him. Hello? If the recipient is receiving the asset, not as his capital asset, but as his stock in trade, gift provisions are not applicable on recipient. Will you remember? Provisions of gift are over. With this, we end all the incomes under the specific charge. Do you remember all the incomes? The list I wrote in the first lecture of IFOS. What are the incomes? With those incomes, wherever possible, we have covered few more incomes which are taxable because of general charge. Yes or no? So now let me complete the balanced discussion. Then we are immediately starting with the solution of the questions. Yes or no? Now, see. Now, this was your gift provision. Entire provision you are going to study at home today. Okay? Today itself, finish all these things. See, can you see this note number 2 here? Without consideration, 49.4 is applicable. When 49.4 is applied? Whenever you receive any asset, specified movable asset or immobile property, when you receive it as your capital asset. And for that, the gift provisions are made applicable to you. Stamp duty value of the asset, fair market value of the asset is already considered to determine your gift income under the head IFOS. That stamp duty value, that fair market value will only be taken as the cost of that asset later on. 49.4. Understood? Take your period of holding, and if indexation is available, it will be available for your period of holding only. And asset must be capital asset in the hands of recipient. This is very, very important. They will catch you on this point if they want to. Will you be able to remember this? I have already discussed this clause number 11 with you. Have I? Now all the specific charge income are over. Now see, there are certain incomes which are taxable under the head IFOS only. All the specific charge income we have seen, those incomes will be taxable only under the head IFOS because specific charge is there. Now there are certain other incomes I am just giving you few examples of those incomes. Yes or no? This is not the exhaustive list, because under the IFRS head, nobody can give you exhaustive list. If somebody tells you no, that this is the exhaustive list, only these incomes will be taxed, he is trying to fool you. Because there can be n number of sources of income which are not classified under earlier four heads. Income is there, income is not exempt, and the income cannot be taxed under earlier four heads. How many such incomes can be there? There can be n number of incomes, there can be n number of sources giving you such incomes. So all such sources will be covered under the head IFOS, under general charge. Few examples out of them we can take. And I have tried to cover all those incomes under my examples which are repeatedly asked in exams. But these are not the only incomes which will be taxed under the head IFOS. So because of general charge, these incomes can also be taxable under the head IFOS. Few examples. Yes or no? Number one, royalty income. So if you are writing a book and your book is published, so the publisher will give you royalty. That royalty will be taxable under the head IFOS. Wait. If you are not a professional writer, if you are not a professional author, you are a CA student, no? Are you an author? Are you a writer? You are a CA student. You have written a book, Life of a CA Student, very emotional book. And you got it published. The publisher liked your content, he published that book. And your book is now getting sold, bestseller. All the CA students, reading your book, Life of a CA Student. We are very much correlating with. You have poured your entire heart, your emotions in the content. Because you yourself are a CA student, no? So who will know better that how the life of a CA student is? So you have written a book on that. You are not a professional author, you are not a professional writer, but you have just written a book. And somehow you got it published, and from the publisher now you are getting what? Royalty. If you would have been a professional author or a professional writer doing this activity as your profession only, then the royalty would have been your PGBP income. But now it is your IFRS income. It is an income? Yes. Exempt? No. Taxable under any of the earlier four heads? No. Taxable under the head IFRS. Got it? Sometimes you get remuneration from your non-employer. Do you remember? A college lecturer is there receiving anything from the college will be salary for him. Employer-employee relationship is there. Same college lecturer is setting the paper for the university, checking the university paper, receiving remuneration in the form of paper checking fees, paper setting fees from the university. So university is a person who is giving you some remuneration, but that remuneration you are getting from a person who is not your employer. So remuneration from a non-employer cannot be taxed under the head salary. It has to be under the head IFOS. See, you are a chartered accountant working in a very big organization as a CFO. Very big company, you are working as a CFO. Or since many years, you are doing your practice, international taxation practice. So big institutes are there, like big colleges, etc. They are calling you for guest lectures, to deliver seminars to their students. You will take out some time out of your busy schedule and you will go there. You will, motivate the students. You will, share your insights about the profession with those students, so that the students get motivated to study. Even they come to know that what all areas are there in the international taxation. You are sharing your knowledge with them. So the college is calling you, that university is calling you, that institution is calling you to deliver that guest lecture, to deliver that seminar. Will you be paid for that? Definitely yes. If you are not going to get paid, you are not going to go there. Getting my point? For one day, you are going to appear in front of the student for at least 2 hours. No, maximum 2 hours you are going to appear. You are speaking whatever you want and you'll come out, no, 25 to 50,000 rupees that college will give you. Just imagine how much your knowledge will take you, how much far away. If you get this knowledge and if you get renowned because of your knowledge, many big institutes call you. Come sir, come madam, come give some insights about your career to our students. They will say, yes, hello, like this. And you will be paid for your 2 hours time. 1 hour if you are there, no, you will be called as a chief guest. You will be called as a chief speaker. You are not doing that profession. You are not in that profession. Your profession is something else. You are working somewhere else. You are the employee of some other company. Here the employer-employee relationship is there. You are doing profession. You are earning profession. But other than that, you are going for these universities, educational institutions to deliver your guest lectures, seminar, etc. For that you get some amount. 1 hour you are paid 50,000. 2 hours you are paid 1 lakh rupees. The colleges, etc. throw money like this. That is known as honorarium. Honorarium. That is not coming from a person who is your employer. Remuneration from a non-employer will be taxable as your income from other sources. Yes or no? Insurance commission also you get as an insurance agent from the insurance company. See, if your bread and butter is this only, you are completely in this profession only, selling the insurance policies and earning the insurance commission as your income, your profession is this only, then it is your PGBP income. But what is happening in your spare time, in your idle time from your job, the job which you are doing, you get free very early. So you try to sell some insurance policies, apart from your regular activity. Or for example, you are doing some business, doing some profession. With that business or profession, extra stuff, what you are doing? You are selling some insurance policies. That is not your main business activity, main profession. So whatever insurance policies you will sell, the insurance company will provide you some commission on the sale of those policies. Yes or no? That is not the main income which you want to earn. Your main income will be something else. So this will be your side income. This will be your extra income. Is it your income? Yes. Exempt anywhere? No. Can be taxed under any of the earlier 4 heads? No. So tax it under the head IFOS. Hello sir. Board meeting fees or sitting fees received by the director, already told you, under the head salary, will be your IFOS income because there is no employer-employee relationship. Then family pension. This is important point. Please remember. Family pension if you are getting. See, one employee is there. If that employee getting pension from the employer, for that employee it is salary income. But after the death of the employee, see, whatever pension which the employee receives from the employer, the entire discussion we have completed in salary. Don't ask me that discussion now. I'm not going to talk about that anymore. That can be uncommuted, that can be commuted, uncommuted, fully taxable, commuted, you get the exemption and all. Do you remember that? So if in the capacity of an employee, you are getting it from your employer, then it is covered by salary head. We are not supposed to talk about that. I am talking about that employee dies. And after the death of the employer gives the pension to his family members. So family members getting the pension from employer. Family member gets pension from the employer. Is he the employer of the family member? No. He was the employer of the employee who died. So on his death, his family members are paid what? Pension. That pension which comes to the family members of the deceased employee, that pension is known as family pension. So for those family members, whatever pension is coming, that is their income from other sources. 56(1) general charge. But out of that family pension, they are going to get a standard deduction of 1/3 of the amount of pension which they are receiving, or maximum 15,000, whichever is lower. That standard deduction they are going to get. So whatever family pension received by the family members will be there, that will be their income from other sources. But standard deduction will be given. How much? One third of the family pension received or 15,000, whichever is lower. But remember, if the family member receiving the family pension, he is following 115 BSE, 115 BSE, then the standard deduction will be restricted to 15. No, the limit will be increased to 25,000. One third of the family pension received or 15. No, now it will be 25,000. So there is only one place where it will hit under the head IFOS, under family pension. Getting my point? Rest everything is same. Under 115 BSE, not following everything you follow the same thing. But in family pension, remember the limit of standard deduction is increased from 15,000 to 25,000. If you don't follow, if you follow 115 BSE, yes or no? Now this was the family pension. Now what happens now? There are other pensions also. See, the pension which the employer gives to the employee covered by salary. The pension which the family members receive on the death of the employee, the family members receive from the employer. That is also covered. Now remember, if you invest in some pension plans, if you invest in some annuity plans of insurance company, of UTI, of mutual fund, so from that insurance policy, from that insurance company, from that mutual fund, from the UTI, even the central government's national pension scheme, you are investing money there. So whatever amount you are investing in the pension plans, pension policies, annuity plans, annuity policies of insurance company, mutual fund, UTI, or even you are investing in the national pension scheme of the government, Atal Pension Yojana of the government, and from that investment, whenever you attain a particular age, you start getting pension. That is not your salary income. That is your investment giving you returns. So that is a return on your investment that will also be taxable under the head IFOS 56.1 general charge. Will you remember this? So I have written UTI, mutual fund, insurance company, annuity, pension plan or policy, pension or annuity from the above plan taxable as IFOS. Now when you get pension from NPS or Atal Pension Yojana, that pension is also taxable as your IFOS income. Will you remember this? Will you remember this? Sure, no? Now pay attention. Now, sometimes the pension plan is taken by you, LIC or any approved insurance company. You have taken a pension plan. Now, under that pension plan, what happens? I am talking only about insurance companies. See, your employer gives you pension, uncommuted pension, monthly amount. Can you commute that amount? Yes. And you can get the commuted pension. That pension gets exempted under section 1010A. Do you remember that? So just like that, whenever you invest some amount in the pension plans, pension policies, pension fund of LIC or some other approved insurance company, so from that pension plan, from that pension policy, pension fund, you are going to get monthly pension. Can you commute that pension also? The answer is yes. So whenever you get a monthly pension from the insurance company, that is taxable as your income from other sources. But when you commute that monthly pension of the insurance company, that commuted pension from the insurance company also gets exempted under section 1010A. So any commuted pension received by an individual from any approved pension fund of LIC or other approved insurance company, that will also be fully exempt under 1010A. Will you remember this? So now to sum up the discussion, no, I will make a small chart for you so the discussion will be completely understood and it will be easier for you to remember also. Sure, no? See, first of all, think that where the pensions can come. Pension can come from employer to employee. Pension can come on the investments. Hello? From employer to employee, commuted pension coming, that can be exempted. And from the investments, whatever pension which was supposed to come from insurance company, even that can be commuted, that can be exempted. Yes or no? Now the pension can come to the family members of the deceased employee, family pension. Few more pensions will come and those pensions are fully exempt. Don't ever dare to charge them under any of the heads. Okay, so I am saying that number one, pension received by employee from employer. If it is uncommuted, then taxable as income from salary. If it is commuted, then exempt under section 1010A. How to exempt, when to exempt, everything you have covered in salary head. Okay, no? Now, if the pension received by an assessee on death of an employee, by an assessee as family member, on death of an employee from his employer, that pension is known as family pension, taxable under the head IFOS, less standard deduction under section 57. How much will be the standard deduction? A, B, 1/3 of family pension received, or maximum 15,000, maximum 25,000 if 115 BSE is followed, whichever is lower. Will you remember this? So employee already covered, family pension already covered. Okay, now we'll talk about investments. Pension, or you may say annuity, from insurance company, mutual funds, UTI, on their pension or annuity plans, policies, schemes, funds. That pension, fixed amount, regularly coming, yes or no? That amount monthly amount which is fixed, that amount will also be taxable as your IFRS income. But here there will be a note. Commuted pension from notified pension fund. This notified pension fund of LIC or other approved insurance company. Since this amount is not a monthly amount, this amount is a commuted amount, lump sum amount coming from the insurance company, no? So just like other commuted pension coming from the employer gets exempt, so this commuted pension will also be exempt. This will be fully exempt under section 1010A. Same section, okay, no? The section where we exempted this, in that same section, this will also be exempted. Will you remember this? Now, if the pension, next point, pension from National Pension Scheme or Atal Pension Yojana of the central government, so this pension will also be taxable as your income from other sources. Don't ever try to exempt these kind of pensions, okay? No, taxable under the head IFOS. Wherever the exemption is there, I have highlighted. See, 1 point exempt and the second point exempt. Now, two more places. See, now the pension received by awardee who has received gallantry awards or his family member. If he dies, then his family members can also get. It will be fully exempt under section 10 subsection 18. So this pension is also exempt. Please remember, don't charge this under any of the heads. Even this pension is fully exempt. Pension received by dependents of members of armed forces. These members died in operational course of duties. So the members of armed forces who died in the operational course of their duties, so their dependents also get the pension. Okay, no? So the pension received by the dependents will also be fully exempt under section 10 subsection 19. Please remember this. Gallantry awards, you know? Gallantry awards? Huh? Give me 1 or 2 examples of gallantry awards. Come on. Let me check. How is your GK? Who gets the gallantry awards? When you show extreme courage, no, in those situations where everyone fails to show their courage, extreme courage in extreme situations, then you are awarded by the government to show that courage. Paramveer Chakra, Mahavir Chakra, Veer Chakra, Ashok Chakra, Shaurya Chakra. Even civilians also get. Okay, so the bus was turning on the hilly areas. All of a sudden it lost its balance and it was hanging. It was about to fall from the cliff. So you saved 10 people from that bus. You showed courage in that situation. You will be given gallantry awards from the government. Even the civilians also get sometime. So whenever there is a person who has been awarded by the government some gallantry award to show some extraordinary courage in situations where everyone fails, so for that courageous act you are being given gallantry awards. Few examples I gave. You are paid pension from the government also. But sometimes posthumously also you get gallantry awards. Posthumously means after the death. You know about Major Vikram Batra? Have you heard his name? Do you know Kargil War 1999? The most important cliff where the enemy was sitting and he was firing. That cliff, he won for us. Major Vikram Batra. He got shot many bullets. But even after, he got shot by many bullets, no? He showed so much of the courage. He led his entire team and conquered that cliff. And because of because of that cliff which we won, because of his courage, we won. We won that entire, battle. Because the enemy was at such a place, where they were having an upper hand on us. From there they were firing. We were not able to, reciprocate to that fire. And we were losing many of our artilleries, many of our, armed forces members because of the firing happening from that place. So he went with his very small few people, his team, and he went there and he conquered that place. He was shot many times, but he did not give up. After he died in that battle, till the time he was alive, he saw that tricolor flying on that cliff. He saw that we have won. Then he, left his breath. Then he died. And when entirely his team won, then after his death, his team told everyone that how much courage he showed, what he has done. In that situation, even being hit by one bullet, he would have died. But he took so many shots on him and he did not die. And he stood there. He killed so many of the people of the enemy. And because of his courage only we were able to do it. Otherwise we were not able to do it. So after he died, Major Vikram Batra, his family was given gallantry award for him posthumously. So that posthumously that award was given. Gallantry award was given. But now he is not alive to get the pension. His family is getting the pension. Fully exempt, 1018. Sometimes in the operational course of duties, the members of our armed forces like Army, Navy, Air Force, Police Force, yes or no, they are the members of our armed forces, paramilitary force, special forces. In their operational course of duties, they are going to fight with a terrorist. Terrorist attack has taken place. So they are going to counter that. They have been deployed in the border area. All of a sudden the shelling has started from that side of the border. So they are doing their duties. They are performing their duties. So in the course of their operational duties, sometimes they lose their lives. We call them our martyrs. Yes or no? So after their death, their family members, who are dependent family members, their widows, their children, their dependent parents, they are paid what? Pension. That pension is a family pension only, but it will be fully exempt. 10 subsection 19. Will you remember this? Everyone. So these two pensions, this pension and color blue, this pension, you are not going to charge under any of the heads. But first one, charge under the head salary. Second one, charge under the head IFOs. Take the standard deduction. Yes or no? Here, charge under the head IFOs. This one also, charge under the head IFOs. But not these two. Will you remember this? This is your entire pension at one place. Got it, sir? Everyone, pay attention. Now, next one. After pension. Agricultural income, do you remember? Agricultural income we have done from a land which is situated in India. Fully exempt. But the agriculture income coming from a land which is situated outside India will be taxable as your income under the head IFOs if you are ROR. Irrespective of the fact that where you have received that income. In India also, then taxable. Outside India also, then it is taxable. What if your status is RNOR or NR? It will be taxable for you under the head IFOs if you are receiving it in India. Then it becomes your Indian income. Hello? But what if you are RNOR or NR, agricultural income from a land situated outside India, you are receiving outside India will not be taxable. Because that is your foreign income. But for you, ROR, it is still taxable in India under the head IFOs. But will you charge agricultural income from a land situated in India? No, that is fully exempt under 10(1). And this is taxable based on your residential status and the place where you are receiving this income. But whenever it will be taxable under the head IFRS only. Getting my point? Income from units of UTI or mutual fund, this I have already told you, will be taxed. Just like your dividend income. Dividend on shares taxable under the head IFRS. So dividend on units also taxable under the head IFRS. From dividends, will you get any deduction for expenses, etc.? No. So from the units also, the dividend from units also, you are not going to get any deduction for any expense. Only one deduction you can claim. From the dividend of shares, from the dividend of units, only one deduction you can claim. The deduction for interest on loan. Loan taken to invest in the shares, loan taken to invest in the units. On that loan, whatever interest you have paid, that interest will be allowed as a deduction, but only to the extent of 20% of that income. Do you remember all such things? Now, MP, MLA, MLC, our ministers, etc., they also get salary. So their salary is not income from salary. There is no employer-employee relationship between them and the government. So their salary is their income from other sources. But sometimes, along with that salary, they also get daily or constituency allowance. So salary also they are getting. Salary will be taxable under the head IFRS. But along with the salary, they are getting what? Daily or constituency allowance. This is an allowance given to them because in their constituency, they are meeting many people. They have to go to different places to meet some people. Some people might come to meet them. So there will be expenses which they have to incur in, meeting with the people in their constituency, listening to their problems, going here and there, spending some money for some work. So to meet all such expenses which he might incur in the course of performing his duties as MP, MLA, MLC, to meet such expenses, one allowance is given. Daily allowance or constituency allowance. Whenever he will get such type of allowance, it will be fully exempt in his hands. Yes or no? But no exemption under 115 BBC. It will be exempt only under. What? If you don't follow 115 BSc, normal tax regime. Getting my point? Everyone? Next one. Now, if you get any award or reward from the government in the public interest, and now I'm not talking about gallantry awards, that is done. If you are getting any award or any reward, including gallantry awards are also covered, okay, no? But other than gallantry, any award or reward which you are getting from the government, like Padma Shri, Padma Bhushan, Bharat Ratna, Major Dhyanchand Khel Ratna Puraskar, Dada Sahab Phalke Puraskar. There are many awards which are instituted by the government. Or rewards also sometimes you get. You win in the Olympics. Gold medal you are getting. So some rewards are announced by the governments, no? State government, central government also. So whatever awards or rewards which you are getting from the government, if they are coming in the public interest, the amount of that award, amount of that reward, fully exempt. 1017A, A for awards, fully exempt. But if you are receiving that award from your employer as an employee, in the capacity of an employee, what will happen? Taxable as your income from salary, profit in lieu of salary. If you are receiving that award as a professional sportsman or an athlete, it is received by you in the course of your profession, taxable as your PGBP income. If you are receiving award in any other case, then it is as good as gift, something which you receive without consideration, taxable as gift under the head IFOS. Getting my point? So this award exempt, this amount exempt, this amount taxable under salary, this award taxable under PGBP, all other awards taxable under the head IFOS, as if they are gift only. Getting my point? Hello? This I have already explained. Activity of owning and maintaining resource. From that activity, whatever income you are receiving, that is take money, minus the amount spent on that activity. All the expenses you can claim as a deduction. In that activity, whatever losses happen to run that activity, all those losses are also allowed as a deduction. you can claim the set off of losses from this income. Even chapter 6 said deductions are allowed from this income. Now, after claiming deduction and all, set off and all, this income will be shown as a part of your GTI. From that, you are going to get chapter 6 deduction also. After claiming chapter 6 deduction, whatever income remains will be taxable as if it is your normal income only. Just like your other normal incomes, this is also your normal income, taxable at normal rates. Winnings is different. Winnings from horse races is different from this. From winnings, you are not going to get any deduction for expense, losses. No losses can be set off. Entire winnings you have to show under IFOS. No losses can be set off, meaning entire winnings will be shown under the head, shown in GTI. From GTI separate it. From that you are not going to get any chapter 6 deductions. Hello? Entire winnings will be shown as a part of your total income. Separate it. You are supposed to pay special tax at the rate of 30% under section 115BB or 115BBJ. Special rate of tax. So these two incomes are separate types of incomes. Please remember this. Okay, now do you remember PGBP head? We did PGBP head. Under the PGBP head, from your business income, what did I say? From your business income, whatever expenses you are taking as a deduction from your business income, the same type of expenses you are incurring to on your IFRS income can be claimed as a deduction under the head IFRS also. Section 57. But the expenses should not be of personal nature, should not be capital in nature, should be wholly and exclusively incurred to on your IFRS income. Yes or no? Hello? Then all such expenses wholly and exclusively incurred to on your taxable IFRS income, they will be allowed as a deduction. Capital expenditure will be allowed or will not be allowed? Give me 10 minutes, I am winding up. Within 10 minutes only. Okay, no? So, capital expenditure will be allowed or will not be allowed? Will be allowed? No. Capital expenditure under PGBP also you cannot claim as a deduction. You have to claim it in the form of depreciation. So here also capital expenditure will not be allowed. But that can be claimed in the form of depreciation. For example, plant, machinery, furniture is there. For example, plant, machinery, furniture is there. That plant, machinery, furniture you are giving on rent. Plant, machinery, furniture you are giving on rent. So the rent is not taxed under the head PGBP. So that rent will be taxable under the head IFRS. Yes or no? To earn that rental income, you had to buy the plant, machinery, furniture. Capital expenditure or not? The cost of the plant and machinery and furniture will be allowed as a deduction in the form of depreciation under the head IFRS. And you will calculate in the same manner in which you have done under the head PGBP. Will you remember this? Now please pay attention. Under the head IFRS, no, some incomes you have seen, exempt incomes are there. Under the head IFRS, some exempt incomes you have seen. To earn exempt incomes, whatever expenses you are incurring, no, forget it. Incomes we are forgetting, expenses you forget. So to earn exempt income, whatever expense you will incur, ignore. Not to be claimed here. Here, nowhere under the Income Tax Act. Because the income for which the expense is incurred, that income is not taken in the computation of total income. So the expense to earn that income will never be allowed as a deduction while computing your total income. Forget the income. We have forgotten the income, you forget the expense. Will you remember this? Number 2, which other income we have seen here? Second income, winnings income. Do you remember winnings? Any expense or loss, etc. incurred to earn the winnings income will never be allowed as a deduction. So expenses in relation to winnings also ignore. Third income, some incomes from which standard deduction is given. Two incomes are there. Interest on compensation or enhanced compensation, 50% standard deduction. Family pension, 1/3 of family pension or 15,000, whichever is lower. And if you are following 115 BSc, then 25,000. Hello? So from these two incomes, you are going to get what? Standard deduction. So to earn these two incomes also, whenever you have incurred some expenses, forget. We are giving you standard deduction. Why are you claiming expenses? Forget. 3 incomes. Last one, fourth one, dividend income. Dividend on shares, dividend on units. Any expenses incurred will be ignored. Only one expense will be allowed. Which one? Interest on loan taken to invest in the shares, taken to invest in the units will be allowed as a deduction to the extent of 20% of income. Will you remember these four incomes? Apart from this, any other taxable income under the head IFOS. Any other taxable income under the head IFOS. To earn that income, whatever amount of expense you have incurred should not be personal in nature, should not be capital in nature, wholly and exclusively incurred to earn the taxable income will be allowed as a deduction. Section 57. Now, income can be higher and the expense can be lower, resulting into final taxable income. Hello? Income can be equal to amount of expense. Then there is no taxable income, no loss. But if the income is lower and the expenses are higher, full expense will be allowed as a deduction because the entire expense is incurred to earn the income. So the entire expense will be allowed as a deduction, whatever may be the income. Hello? It will result into loss also sometimes. And that loss will be allowed for set of carry forward. What if you are incurring some expense, but in return no income is happening? Still the expense will be allowed as a deduction. You just have to prove that the expense was incurred wholly and exclusively to earn the income. If you prove it, then whatever income happens, or even if no income happens, still you are going to get the deduction for that expense. Remember, all the expenses which you used to claim to calculate your PGBP income, same type of expenses you can claim here also. Section 57 over. At home, you are going to read this entire section 57 today itself. Whatever written, everything I have explained, not a single thing I have left. Okay, no? Now 58. Do you remember under the head PGBP, there were certain disallowances? If you make the payment for expense, you don't deduct TDS. And the payment was made to non-resident, entire payment, 100% of that payment disallowed. If you make the payment for an expense to a resident, from that payment you are not deducting TDS, 30% of that payment disallows. Then if you are making the payment for an expense in a day to a person, the amount of payment is more than 10,000 and you are paying that by way of any mode other than prescribed modes, entire amount will be disallowed. Making the payment for an expense to a related party, specified person, of an amount which is unreasonable or amount which is more than reasonable amount, then whatever unreasonable amount you have paid will be disallowed. Have we done all those things? Copy, paste. But you will now refer section 58 because under the head IFOS, whenever there will be a disallowance, that disallowance will be under section 58. Hello? Under the PGBP head, there were different sections to disallow different items. No, all such items are combinedly disallowed under IFOS under the same section 58. Will you remember this? So whenever you will disallow anything here, see, to earn the winnings, you incur some expense. Those expenses are also disallowed as per 58. Getting my point? And all the disallowances which are applicable for PGBP equally applies here also. No need to forget, no need to remember anything. Getting my point? Last section 58 done. Now last 59. See, any expense, any loss, any liability. What did I say? Any expense, any loss, any liability which you have claimed as a deduction under the Income Tax Act other than PGBP head. Because if you will claim it under PGBP head, against that whatever recovery or benefit you are going to get, that is already treated as your deemed PGBP income, no? So I am talking about expense, loss or any liability for which you have claimed the deduction under any of the provisions of Income Tax Act other than PGBP. Other than PGBP, have you claimed any expense deduction? Yes. Have you claimed any deduction for liability, loss, etc.? Anywhere under the Income Tax Act. Now, against that loss, against that liability, against that expense, whatever recovery or benefit you are getting, no, that recovery or benefit will always be taxable under the head IFOS as your deemed income. Section 59 done. The same provision 41 we did, copy paste only. But under 41 what was there? If the deduction was claimed under the head PGBP, then it will be deemed as your PGBP income. But here they are saying other than PGBP under the entire Income Tax Act if the deduction was taken, and against that if you are getting any benefit or recovery, then that benefit or recovery will be treated as your deemed income under the head IFOS. And 3 incomes where you are not supposed to apply what method of accounting: dividend income, interest on enhanced compensation, and interest on compensation or enhanced compensation, and last but not the least, advance money received and forfeited on or after 1st April 14. These incomes will be taxable. The way in which they are taxable, it is prescribed that they are taxable in this manner. In that manner they have to be taxed. For other incomes you apply no method of accounting. Regularly method of accounting mercantile basis, no. This year's income, whether received in this year, not received in this year, taxable in this year. All other incomes do that, but not for these 3 incomes. Oh, cash basis you are following. So the income does not relate to this year, it relates to some other year. Received in this year, taxable in this year. Income for this year, received in this year, taxable in this year. You are following cash basis, no? So follow cash basis for all your income, follow mercantile basis for all your incomes, but these 3 incomes you are not going to follow what method of accounting. Will you remember? So this is the end of notes, meaning the end of chapter. How was this chapter? Interesting, no? Good. Let's solve the questions. See, question number 1 we have already done, if you remember. Question number 1 was that was on dividends. Okay, no? Illustration number 1 we have already solved. Okay, illustration number 1 already done. Tell me illustration number 2. Can you see your illustration number 2? Come to this part. Okay, now see, gift provisions. Do you remember gift provisions? So this illustration talks about the gift provisions. Okay, no? I'll read the question. Mr. A dealer in shares, received the following without consideration during the previous year 24-25 from his friend Mr. B. See, he is getting these things from his friend. Friend meaning not a relative. Okay, so he is getting these things from the relative. See, if he is getting shares, no, he is a share dealer. If he is getting shares, then gift provisions will not be applicable, because something which you receive in the form of capital asset only, gift provisions will be applicable. Do you remember? So he is a share dealer in shares. So his business is to deal in shares, buying and selling of shares. So for him the shares will be stock in trade. So if he is getting shares without consideration or for inadequate consideration, for him that benefit will not be treated as his gift. Gift provisions will not be applicable if he is receiving shares without consideration or inadequate consideration. Getting my point, everyone? So now what he is getting without consideration? Cash gift 75,000 on his anniversary. Wow. So this year his anniversary is there. On his anniversary he is receiving sum of money which is more than 50,000. Will it be taxable? Yes or no? T for taxable. Okay. Now bullion means jewelry. The fair market value was 60,000 on his birthday. This year only his birthday. So one gift he is receiving in April. This is cash gift. Another gift he is receiving in June. This is also without consideration jewelry. So the value of that jewelry is more than 50,000. This will be taxable fully. Okay. Now next he is getting plot of land at Faridabad on 1st July 2024. The stamp duty value is 5 lakhs on that date. He is getting immovable property without consideration and the value of that is 5 lakh, more than 50,000. So this will also be taxable. Now Mr. B had purchased the land in April 2009. So the person from whom he is getting, Mr. B, his friend, Mr. B had purchased in April 2009. For how much? For So the cost is not given. So whatever cost the B had purchased as per 49.1, it would have been his cost? No. Because now 5 lakh rupees is treated as his gift. So the stamp duty value of this property is treated as his income under the head IFRS. Now whenever Mr. A will sell this immobile property, what will be his cost of acquisition? This stamp duty value as per 49.4 later on. But right now this 5 lakh will be taxable for him. Yes or no? Cost to previous owner not to be taken. Period of holding of the previous owner not to be taken. Only stamp duty value will be taken as cost. Only his period will be taken as cost. That only we have done, no? Okay, next one. Mr. A purchased from his friend C, who is a dealer in a shares, 1000 shares of X Limited at 400 each on 19 June 2023. So he purchased 1000 shares in 19 June 2023. At what price he had purchased? 400. The fair market value of which was 600 each on that date. Mr. A sold these shares in the course of his business on 23rd June 2024. See, no, whatever stock in trade he bought, no, in 23-24 for 400, that stock in trade he is selling right now. At the time when he bought, the fair market value was 600. At that time he bought for 400. So friends, that time it was not taxed in his hands as gift, no. So can I say in the previous year 23-24, when he bought, that time the fair market value was 600. He bought it for 400. So 200 was the benefit on 1000 shares, meaning that 2 lakh was the benefit. Don't you think that this 2 lakh was not treated as his income from other sources because 56-10 was not applied only? Now whenever he'll sell these shares right now, for how much? In the course of his business, he's selling right now. So whatever price he'll sell it, from that price, selling price, his 400 cost will be reduced. By the way, these shares did not come to him as his capital asset. So if he is going to sell these shares, his PGBP income will be calculated. To calculate that PGBP income, what will be the cost? The fair market value as on the date on which he got it? No, the actual cost at which he bought it. Done? So this entire information is given to calculate his PGBP income. Okay, next one. Further, on 1st November 2024, Mr. A took possession of a property, office building, booked by him 2 years back at 20 lakhs. 2 years back he booked for 20 lakhs. Okay, so that time he did not give 20 lakhs. 2 years back he booked at 20 lakhs. The stamp duty value of the property as on the 1st November 2024 was 32 lakhs. Okay, and on the date of booking was 23 lakhs. He paid 1 lakh by account pay check down payment on the date of booking. Yes, now they are saying that as on the date of booking he paid. Now tell me, two dates are there. Date of booking is there and date of possession is there. Date of booking is 1st November and date of possession is later on. Okay, no? Okay, no. Possession date is 1st November. Date of possession is 1st November. Okay, no? 2024. And A took possession of the property booked by him 2 years back at 20 lakhs. Now, right now, he is getting the possession of the property. Right now, he is getting the possession. So, the stamp duty value of the property as on 1st November 2024 was 32 lakhs. And as on the date of booking 2 years back, at that time when he booked, okay, that time, what was the value? 23 lakh. So, that time only, he has paid how much? 1 lakh rupees booking amount. He is not paying 1 lakh rupees booking amount right now. He has paid the booking amount that time only, 1 lakh rupees. Getting my point, everyone? See, the booking amount paid by him was, at that time the stamp duty value was 23 lakhs. 32 lakh is the stamp duty value right now at the time of taking the possession. The transfer is happening to him right now. But at the time when he booked, at the time when he booked, at that time only he has paid 1 lakh rupees by way of prescribed mode. So the stamp duty value as on the date of possession you will take, or the stamp duty value as on the date of booking you will take? Date of booking. That stamp duty value. And now see at how much you have acquired. 20 lakhs. And now since you are acquiring, taking the possession right now, no. So that 3 lakh benefit is happening to you right now. Getting my point? So whenever you will get the property, you will get the property right now. 1st November 24. How much? 20 lakhs you are saying you are buying for 20. Oh. Right now what was the stamp duty value? 32. So 32 minus, no, don't take 32. Take 23. The stamp duty value as on the date of booking. Yes. Because as on that day, you have already paid 1 lakh out of the consideration by way of prescribed modes. So that stamp duty value will be considered to determine the value of your gift. So tell me, 20 lakhs minus 23 minus 20, 3 lakh rupees difference. This 3 lakh rupees difference is more than 10% of 20 lakhs, more than 2 lakhs. Hence the entire difference you have to check. 2 lakh rupees you have to check whether it is more than 50, whether it is more than 2 lakhs. No, whether it is more than 2 lakhs. So difference of 3 lakh is more than 2 lakhs, no. So this value of 3 lakhs will be taxable to him as his gift. Got it, sir? So they are saying on March 1st, 2025, he sold the plot of land at Faridabad. See, the plot which he acquired from his friend. Do you remember this one? This one. Okay. He is selling it. For how much? 7 lakhs. Can I say capital gain will be calculated here? So to calculate the capital gain, full value of consideration 7 lakhs. Yes or no? Minus transfer expense, nothing. Net consideration 7 lakhs. What will be the cost of acquisition? 49,400. The entire 5 lakh stamp duty value of this plot charged under the head IFOS will now be taken as your cost of acquisition. So 7 lakh minus 5 lakh. 2 lakh will be your short term gain. Why short term gain? Because you acquired in 1st July and you transferred in 1st March. Period of holding is less than 24 months. Short term gain. To calculate short term gain, what will be the cost? As per 49,400, 5 lakh rupees. Mark this question important. Good question this is. This is testing all the knowledge which you are having for gift provisions. Yes or no, sir? Now what they are saying, compute the income of Mr. A chargeable under the head IFOS. Now what income will be chargeable under the head IFOS? Come on, tell me. See, looking at this thing, we can say that this amount will be chargeable 75,000. This 60,000 will also be chargeable. And can I say this 5 lakh will also be chargeable under the head IFOS? So 5 lakh plus 60,000 plus 75,000. This amount will be chargeable under the head PGBP. This is nothing to do with IFOS head. This is deliberately given to confuse you. Okay? Deliberately given to confuse you. Nothing to do with your IFOS head. Because the shares which you are acquiring in the form of stock in trade. And on that, whatever benefit is happening is not happening right now. It happened last year. And last year, that was not taxed as your gift. So this year also will not be taxed as gift. Whenever you will sell the shares as your stock in trade, that time the PGBP income will arise. So whatever gain happening at the time of acquisition will be automatically taxed in the form of PGBP income. Yes or no? So there is no IFOS income arising last year also and in this year also for this transaction. Okay. Next one. Here there is 3 lakh rupees of IFOS income. So can I say 5 lakh here, 60,000 here, 75,000 here and 3 lakh rupees here. So 5 lakhs plus 3 lakhs plus 60,000 plus 75,000. Can you have 9 lakh 35,000? That 9 lakh 35,000 is your IFOS. Can you see this? Now you just have to write sum of money received without consideration since the amount is more than 50, entire amount taxable, outer column taxable. Asset received without consideration, fair market value is more than 50, entire amount taxable. So immobile property whose stamp duty value was more than 50,000 received without consideration, entire value taxable. Immobile property purchased for a consideration which is less than the stamp duty value. Take the stamp duty value 23 lakhs. Purchased for 20 lakhs. The difference between the stamp duty value and the consideration 3 lakhs, which is more than 50, no, more than 10%. Hence that entire difference is also treated as what? Gift, taxable under the head IFRS. You just have to write down this in particulars and write down the amount. That's it. Will you be able to do it? And they are telling you to calculate what? One more thing. And capital gains also. So the capital gain arising on transfer of this plot of land which came to you as a gift. So the asset which came to you as a gift, for which 56(2)(10) provisions got applied. So for that asset, whatever stamp duty value, whatever fair market value which you took for determining your gift taxable under IFRS, that stamp duty value, that fair market value of that asset will be deemed to be the cost of that asset as per 49(4). So whenever that asset will be sold in future, to calculate the capital gain, cost will be as per 49(4). Cost will be stamp duty value or the fair market value taken for gift purposes. Hello? That only you have taken. See here, 7 minus 5, 2 lakh will be capital gain, and the gain will be short term. Why the gain will be short term? Because you acquired in July and you transferred in March 25. That's it. Period of holding is less than 24 months. Will you be able to do it? Sure? Very good. Now pay attention. This one. Illustration number 3. Discuss the taxability of otherwise of the following in the hands of recipient under section 56(2)(10). Recipient you have to think. So do the same markings which I have done in your question also. Same markings you are supposed to do. Akhil HUF received 75,000 in cash from niece of Akhil. That is daughter of Akhil's sister. Akhil is Karta of the HUF. See, Karta of the HUF, his wife, his children will be the member of the HUF. My sister is not member of my HUF. And neither her daughter is the member of my HUF. My sister is married to my brother-in-law. She is the member of that HUF. My sister's daughter, who is my niece, is the member of her father's HUF and not my HUF. Am I receiving the gift in the capacity of an uncle? No. Even if I would have received the gift in the capacity of an uncle, no, still that gift would have been taxable for me. Because for my niece, I am her mother's brother, parents' brother. For her, I am her relative. But for me, she is not my relative. But I am not getting the gift in my individual capacity. I am getting the gift in the capacity of HUF. HUF is getting the gift from a person who is not the member of the HUF. So this niece of Akhil is not the member of the HUF. Hence, she is not the relative for the HUF. Hello? So HUF is getting a gift from a relative or a non-relative? Non-relative. How much is the amount of gift? 75,000, more than 50. Entire 75,000 taxable for HUF. Hello? Will you remember? Next one. Nishita, a member of her father's HUF. Nishita is the member of her father's HUF. Very good. Transferred a house property to HUF without consideration. The stamp duty value of the house property is 9 lakh rupees. Now who is getting the gift? HUF only getting the gift. Now the HUF is getting the gift from the member, meaning relative. So whatever may be the amount of that gift will not be taxable because it is coming from the relative. Hello sir? Will you remember sir? Next one. Mr. Akshat received 100 shares of A Limited from his friend. Friend is not a relative. So from a non-relative, if you are getting shares, specified movable asset, and your business is not dealing in shares, so for you the shares are capital asset. Yes or no? 100 shares as a gift on the occasion of his 25th marriage anniversary. Marriage anniversary gift taxable, huh? Provided the value is more than 50. So what is the value of the shares? Value of the shares is 100 per share. 100 into 100 will be 10,000 only, sir. The fair market value of the shares is 10,000 only. Not taxable, sir. But wait. If that is the only gift received during the previous year, then the aggregate is 10,000, not more than 50. But during the previous year, he is getting one more gift. Gift of what? Jewelry worth 45,000 from his nephew. If I give him, for him, it is not taxable because for him, I am his relative. But if he gives me, he is not my relative. For me, my brothers and my sisters, children are not my relatives. So if they are giving me any gift, will it be taxable for me? Yes, absolutely. Provided the value is more than 50. Now during the previous year, you are getting two gifts from non-relative. Both the gifts amount is 10,000 and 45,000. The total amount is 55,000. Aggregate is more than 50. Entire 55 will be taxable. Yes or no? Now, son of Karta is getting the gift from HUF. Karta's son is the member in the HUF. Hello? So, member is getting the gift from HUF. For HUF, member is a relative. So, for member, HUF is also a relative, no? So, son of Karta is what? Recipient. Getting the gift from HUF. From relative only. So, this gift is not taxable because it is coming from relative. And number two, the asset which is gifted is car, not a specified movable asset. So, whatever may be the value, the gift will not be taxable. What if it was jewelry? Then also it was not taxable because it is coming from relative. So, two reasons. One, coming from HUF, meaning coming from relative. Number two, the asset is also not a specified asset. Hence, both the reasons are sufficient to not charge this amount under the head IFRS. Yes or no? The same type of question. Next question. Not next question. One more question later on you will get. This question number 4. Do you remember? We did 4 examples. Connectivity of capital gain and gift provisions. Now that will be helpful over here. Now pay attention. This question is important. I was talking about this question only. Illustration number 4. Mark this question important. Mr. Hari, a property dealer. See, for this property dealer, his properties are stock in trade. For this property dealer, properties are stock in trade. Okay, no? Sold a building means he is selling a stock in trade. In the course of his business to his friend, Mr. Rajesh, who is a dealer in automobile spare parts. So for Rajesh, the building is not his stock in trade. Because Rajesh is doing a business of automobile spare parts. So Rajesh is taking that building as a capital asset. Rajesh is purchasing as a capital asset and Hari is selling as a stock in trade. What? Building. Immovable property. Now, how much is the sale consideration? 90. Now, if I write H and if I write R, Hari is selling his stock in trade and Rajesh, who is not a dealer of property, he is dealer of automobile spare part, he is taking the property as his capital asset. Yes or no? Now the property is sold by Hari to Rajesh for 90 lakhs. 90 lakhs is the selling price. Okay, no? On 1st of January 2025, when the stamp duty value was 150 lakhs. The agreement was, however, entered into on 1st of September 2024. Meaning the sale happened on 1st of January 25, but the sale agreement got entered prior to that on 1st September 24. And as on the date of sale agreement, the stamp duty value was only 140. Now you have two stamp duty values. One is as on the date of sale agreement and another as on the date of registration, as on the date of sale. Which stamp duty value you will take? Always 150. But if the consideration 90 lakhs or any part thereof is paid by way of prescribed modes on or before 1st September, then you will ignore 150 and you will take 140. Everyone. So, Mr. Hari had received down payment of 15 lakhs by crossed check from Rajesh on the date of agreement. By the way, crossed checked is not a prescribed modes, friends. It is a crossed check. Account pay check is a prescribed mode. Meaning that as on 1st September, what did I say? As on 1st September, as on the date of sale agreement, is the consideration received? Yes, but it is not received by prescribed mode. So the stamp duty value as on the date of sale agreement cannot be taken. The stamp duty value as on the date of sale, 150 lakhs, that will be taken. Getting my point? Now tell me, 90 lakh is the sale price and 150 lakhs is what? Stamp duty value. Now for Hari, who is selling it as a stock in trade, can I say stock in trade is sold for a stamp duty, sold for a consideration which is 90 lakhs. Stock in trade is sold for a consideration which is 90 lakh, which is less than the stamp duty value 150 lakhs. Stamp duty value is more as compared to the selling price. And the difference between both of them, 60 lakhs, is more than 10% of 90 lakhs. 43 CA will apply. And as per 43 CA, Hari will show 150 as his PGBP income. Hari will have to show 150 lakhs as his PGBP income and not 90 lakhs. And don't you think for Rajesh, Hari is not his relative? And Rajesh is taking the asset as a capital asset. For Rajesh, 56 subsection 2 clause 10 will be applicable, gift provisions will be applicable. So under the gift provision, he is buying an immobile property for a consideration which is less than its stamp duty value, and the difference between both of them is 60 lakhs. Is this difference more than 50 or more than 10%? Whichever is higher, more than 10%, no. So for him, that 60 lakhs will be treated as his income from other sources. This is the effect which they want you to discuss. This entire thing is given here in 2 pages. And just see how easily you have done it. This is the magic of Umang sir. Say thank you. Say thank you. But wait. In that same question, no, they are telling you, discuss the tax implications in the hands of Hari and Rajesh, which we have discussed. Assuming that Mr. Hari had purchased the building for 75 lakhs on 12th July 2023. Wait, he has purchased on 12th July 23 and he has sold on 1st January 25. The period of holding, you don't have to see only. Why? Because he is selling as stock in trade. So for stock in trade, you don't see period of holding. What will be the PGBP income? 150 minus 75 lakhs will be his cost of stock in trade. So 75 lakhs. Here you will reduce 75 lakhs. So what will be his PGBP income? 75 lakhs will be taxable for him under the head PGBP. And for Rajesh, 60 lakhs will be his. 60 lakhs will be his IFRS income, gift income. Now, in the same question they are saying, would your answer be different if Hari was a share broker instead of property dealer? Absolutely, my answer would have been different. Now the Hari is not selling the asset as a stock in trade, he is selling the asset as his capital asset. So 43 CA will not be applicable, 50 C will be applicable. So this 150 lakh is still taxable for him as his full value of consideration to calculate his capital gain. And now his capital gain will be short-term capital gain amounting to 75 lakhs. Why? Because he acquired the property on 1st of July, 12th July 23 and he transferred on 1st January 25. The period of holding of this capital asset of Hari was less than 24 months. So the short-term gain will be calculated. To calculate that short-term gain, 150 will be taken as full value of consideration as per 50C now. Will you remember this? Easy, no? Now this entire story, no, which I have explained is given here. Today you are sitting at home and reading this entire story. You don't have to write this answer like this. Okay? No need to write down all these stories. Just write down in a manner, presenting in a way in which we are presenting. Hari, Rajesh. Hari, what is doing? Rajesh, what he is doing and what is the tax treatment. That's it. No need to write down all these things. The same thing which we have done, no? You're supposed to do it like that only. Will you be able to do it? Sure, everyone? Next question. See, 60 lakhs here, 75 lakhs here, 60 lakhs here, 75 lakhs here, and this is 43 CA. Now here it is 50C. The same thing which we have discussed. Understanding? Next one. Now come to Question number this was 4, no? Question number 5. See, this is a theory on 1010 BC. There is one exemption given under 1010 BC. Okay, I will first explain that 1010 BC, then you are going to read this. That's it. See, whenever a disaster takes place, disaster can be a natural disaster or it can be a man-made disaster. Just now, few days back, last week only, one disaster has taken place. If you would have heard about cloud burst in Uttarakhand, the entire village got washed away. Did you see that video of that? The cloud burst, the entire water in the cloud came down and it wiped away the entire village. So many people died, so many things got wiped out. So that is a disaster, no? Last month, one plane got crashed in Ahmedabad. That is also a disaster. So whenever some disaster happens, no, there is a loss of life, there is a loss of, normalcy. What happens in that case? Somebody has lost the life. So their family members will get the compensation. Or somebody became incapacitated. Incapacitated means handicap, etc. So they will get the compensation. So as a result of disaster, some loss is happening. To compensate for that loss of life, the family members will be given some amount, or loss of hands, legs, becoming handicapped. Okay, no? So to compensate for that loss, some amount is given as a compensation. Who is going to give that amount? Either central government or state government or a local authority. So any compensation on disaster received by any person from government or a local authority fully exempt under 1010 BC. Will you remember? But wait, sometimes the loss which has happened, you have already claimed that loss as a deduction under Income Tax Act. Possible, no? You are running a business and as a disaster in that business some loss happened. Your entire stock got washed away. So that stock which got washed away, that was a loss happening in the business. You claimed it as a deduction under the head PGBP. And now against that, if you are getting any compensation, you cannot claim that compensation as exempt under 1010 BC. Now you will have to show that amount as your deemed PGBP income, because that is coming against a loss which you have already claimed as a deduction under the Income Tax Act. Hello, sir. So any compensation coming for a loss which is already allowed as a deduction under the Income Tax Act, against that, whatever compensation you will be receiving, that will not be exempt. That will be your deemed PGBP income. Yes or no? But if it is coming from central government, state government or any local authority to any person who has lost the life, or to his family members, yes or no, who has become handicapped, to that person or his family members on his death, then that compensation on disaster is fully exempt. Okay, will you remember this? Read this at your home. Okay, so correct or incorrect, you have to show this. Now coming to the next question. Sixth question we have already done, if you remember. Sixth question we have already done, no? Okay. Now after sixth, there is test your knowledge. Question number 1 is your homework for today. I am going to discuss it tomorrow. Question number 1 is your homework. You just have to tell, looking at this income, under which head you are going to classify that income. Will you be able to do it? Okay. Next question. Question number 2. Question number 2 is also easy question. Take it as a homework. Now all the 5 questions which are there, no, you will try at home today. I am going to discuss them tomorrow. Okay, one by one I am going to discuss them tomorrow, but you will try them at home today. Will you? All the questions are easy, don't worry. All the questions are manageable, and tomorrow I'll discuss. If at all you are having any doubt, all the doubts will be resolved tomorrow itself. Okay, so tomorrow I'll start with this discussion, and then after finishing this discussion I'm going to start with next chapter, set off and carry forward. Okay, see you all tomorrow, same time, same place, with the same enthusiasm. Bye bye everyone. Bye.